Madness for Coldplay, it's telling me about how the Indian live entertainment scene has now reached a new level with the kind of demand we're seeing.
I think it's also the Indian entrepreneur spirit.
You know what? If you could pay that much for a ticket, travel to the next closest destination and watch.
I believe on that note, I think Abu Dhabi, right after Bombay, is going to be Abu Dhabi. So maybe yes, if you have the kind of money, that's what you need to do is help the Dubai economy do well.
But having said that, it's been a decent setup over the weekend as well. A lot of stocks to discuss today, and it's going to be an exciting morning because NDTV Profit is at the JP Annual India Summit, and in case you're wondering where Niraj is, that's exactly where he is, different part of the city. Niraj, but a lot lined up today, some interesting conversations I'm sure you're looking forward to. And I should ask you as well if you scored any tickets over the weekend.
I got 10 Coldplay tickets and I'm planning to file for an IPO. I mean, that's the joke that is floating around on social media. But good morning, guys. I mean, exciting Friday, such buying. I mean, I'm sure you guys will also talk about it, but his 3-year high net buy number, but gross buy number, I'm told, of the cash plus the futures is the highest ever in Indian history. So, I mean, that's some telling. You saw Vanguard go crazy with 1,000 crores of buying. So it's an interesting one. And, before I hand it over to you guys, yes, we are live at the JP India Investor Summit and a clutch of very important conversations. Sanjay Mukim, Head of Research, will be joining us very, very shortly. And we'll try to ask him, what is it that investors are now seeking with Indian markets at such high valuations? Because, guys, you would have seen that MK note as well. They went to US and they said that long only, and hedge fund investors are now saying, ignore India valuations, we'll go bottom up, but we now want an exposure into India. So I think we at NDTV Profit and our viewers are placed perfectly today and tomorrow at the JP Summit because we'll get access to a whole host of global investors and the JP think tank to tell our viewers what exactly would global investors think of when we are sitting very close to 26,000. Last point here, you guys might just get to celebrate 26,000 from the studio, so I'll envy you guys.
Yeah, it's okay, Niraj. You can join in on the live view and do a little jig from there. We'll include you in the party if we do hit 26,000 today. So
Thank you.
No issues there. But the fact that the global setup is not half bad might help that mood. The way Asia's opened is also pretty decent, and Friday was an interesting day. So let me just do the global setup very, very quickly. US markets were mixed. It was all about the Dow. Dow closed at record highs. Some kind of a pullback, perhaps in the Nasdaq and the S&P 500. So a mixed day of trade overall. Dow futures are also in the positive. Bond yields trending a little higher. I would say, to sum up, that the overall mood is that a soft landing is very much a possibility now. Recession fears have eased because of the good economic data that came in Friday to bolster that 50 basis point cut from the Federal Reserve. So the Treasury yield jumped on those rate cuts, the 10-year at 3.73%. I think crude is the big story and one to watch out for. Obviously, a rate cut has boosted crude's prospects overall in the hope of an increased demand. But escalating tensions between Israel and Hezbollah will also be something to watch for. So you had NYMEX up nearly 1%, Brent now touching the $75 mark, and that's going to be one impact point that we need to see. Gold hit record highs, crossed the $2,600 threshold as well as recession fears are easing. Asia, like I mentioned, we'll just pull up and see where the key Asian indices are at this point, and yes, those are in the green. A lot more to discuss, but I just want to pull up the implied open on the Nifty before we get to Dr. Richard Harris on his view. Wow. Yes, I don't think you have to wait too long to see 26,000 this morning. It's going to be interesting. Today might be the day. So 171 points. You're looking for a rock and roll start. Meanwhile, Dr. Richard Harris joining us, Chief Executive at Port Shelter Investment Management. Dr. Harris, great to have you on the show once again and speaking with us on NDTV Profit. Let's just set the scene. So the rate cut is behind us, better than expected. What's next? What's the next big trigger, and does now attention move to the US elections?
Well, that's right. I mean, the big question now is what is next? What's the next narrative that's going to come around the corner? We've had all the interest rate thing. We've had a lot of excitement in the US elections, so that's going to tick along. But there's no real big narrative out there. Inflation's coming down. You know, that's not a big story anymore. So I think what we're likely to see is the markets maybe tread water for a week or two. Very often when there's no real news, there's maybe more of a downward bias than an upward bias. But I think generally the markets are feeling relatively encouraged. You know, economies are slowing a bit, but haven't really slowed that much. We've had a reaction on the interest rate front towards that. So I think that markets, certainly global markets, are likely to stay in these sort of levels, maybe with no news, a bit of a downward bias. But as we all know, some event will come along in the near future and set the scene.
Okay, so you could see a whole set of sort of movements there. I just want to talk to you about how emerging markets in India now seem, and we'll get to that figure in a bit. But Friday saw a robust fund flow from FIIs, about 14,000 odd crores. And the sense is, and tell me if you agree with that, that you are going to see more aggressive global inflows coming into India despite valuation concerns, etc. Is that something that you're hearing as well?
Yes, I think so. And the reason is that global markets, global developed markets have remained quite strong, probably will remain, as I was saying, you know, at the higher end. And when that happens, investors tend to look for something else. You know, what's different from, say, a US fund or European fund or investing in those sort of areas? And I think the emerging markets are next down the line. The other sector people look at are small caps. So these sectors tend to be next in line. India, I think, has benefited a great deal because people don't want to invest in China. China is still suffering from its post-COVID slowdown, the issues with confidence there. So I think that India does stand out. I think that people are favoring then the smaller markets, maybe some of the smaller Asian markets too. But certainly India is really being, if you like, a competitor to China in this space.
Hi, Dr. Harris. It's also Samina joining in. Up until now, the big worry was India is expensive. We've historically been an expensive market as compared to most of our peers. Do you feel at this juncture any incremental money coming into emerging markets will drive and find its way into India despite stretched valuations, or would investors wait for a correction to add incremental money here?
I think investors do worry about valuations, but it's only one of several factors. Don't forget, it only takes a small allocation out of Western markets to go into emerging markets like India for there to have quite a big impact on those markets. Now, I'm not saying there'll be a continual flow of funds, but it's certainly a situation where people are saying, where can we put maybe a tiny part of our allocation somewhere else, which actually is quite a large amount of money for those markets. So I think that's what's helping India at the moment. People will look at valuations, but then again, look at the US tech sector in terms of expensive valuations. And people still want to put money there because there's an expectation that that's where the growth is going to be. I think the same with India. There's an expectation that the growth is going to be there. And that's what's really attracting investors.
Well, Richard, just another quick one, and I want to move away from equities for a minute, talk to you about asset classes such as gold. $2,600 got hit, I believe, late Friday and early trade across Asia this morning. Gold has had a very strong run from the start of this year, and it's not often that you find gold rallying up in a risk-on environment. At $2,600, what percentage of your allocation would go towards gold?
Well, I've been in favor a little bit of gold for a while, and I must admit I was a rather stale bear for a long time. And I think that this is what we should remember, is that gold, when inflation was going up and going up sharply, didn't really move very much. So it's been a bit of a latecomer to the party. It's catching up now to the kind of global situation that we've seen. Don't forget, gold is also reacting to what's happening in the Middle East, what's happening to Ukraine. So I think there's largely a catch-up in the move that we've seen here. So it may seem a little bit strange that, okay, we've got interest rates coming down, we've got inflation coming down, we've got more of a risk-on situation, gold coming up. But I think we've got to remember that gold is a bit of a latecomer to the party, and it's really catching up. Well, we would have expected it to have done, say, 2020, 2021 and onwards.
Just one last point, Richard, since we've talked about the interest in Indian equities, which are the kind of spaces or sectors that seem like they have a further upside remaining?
Well, I mean, your Indian experts would be better at looking at that than me. But from a global investor's point of view, one of my strategies as a country manager was always to look at what is the country good at? What is it? What is growing in the country? What's especially good? You know, in the US, it has been tech. In Europe, there are areas like luxury goods and pharmaceuticals. This is what those markets are good at. If you look at India, I think people are going to be looking at, you know, the outsourcing sector. They're going to be looking at farmers, maybe generics, the kind of sectors that India is good at and that other countries maybe are lagging behind. So as a global investor looking at India, you really want to invest in the parts of the market that are unique, special, and growing.
Thank you, Dr. Harris. Always great getting perspective from you. That's a view coming on Indian equities, the next big trigger for world markets, and a view on gold. Well, let's do a quick check on how our markets are setting up for trade this morning. Implied Nifty is indicating to a very solid start at the get-go, so a new opening high is what's expected as we gear up for trade today. But let's take you through what happened and why last week turned out to be the week it was. It was a blockbuster Friday, to say the least. The Nifty hit an all-time high in the late hour trade on Friday. It was a new closing high for D Street. The markets ended higher for the second straight week, and it was financials that outperformed the benchmark in quite well. The Nifty was up 1.8% last week and closed about that level of 25,700, just shy of 25,800 in trade. Broader markets, though, ended flat. Fortunately for Friday, broader markets saw some sort of green, and that helped them end flat through the week. Gains were largely led by banks, auto, FMCG and real estate stocks. Nifty Bank is up 3.5% last week for the second straight week in a row. Bank Nifty's also closed above its previous all-time high of 53,350, 55,000 now in sight in the near term, and that's what most traders seem to believe. Real estate was up 4.5%. Auto managed to gain 2% as well. IT, oil and gas and pharma took a back seat. There was some profit taking that emerged across these sectors, with IT losing 3% in trade. What's worth mentioning is that September is on track to log the largest or the highest amount of FPI flows across debt, equity and hybrid funds, with a total investment at a 9-month high. The reason you saw such a big buy number from foreigners in the last few hours of close on Friday was on back of the FTSE all-world rebalancing that led to $1 billion of capital getting reallocated to markets such as India. So that was a key trigger. It was a one-off event that led to a record inflow coming in, largely in line with what was expected. Remember, Europe opened up and the fund inflow picked up steam on back of rebalancing. Well, what lies ahead for us today? Early this morning, it seemed like it could be a morning of consolidation, maybe some profit taking, largely because of what had happened last week on D Street. But with the way implied Nifty is looking like, it seems like it's going to be a big gap up in early hours of trade, but some profit booking cannot be ruled out towards close today. Apart from that, it's also your monthly expiry, so the markets will remain volatile, if not today. Towards the end of the week, Wednesday, Thursday, could see the markets turn fairly volatile. You've also got Bank Nifty that may attempt higher levels, but there could be some sort of profit taking at higher levels with regard to Bank Nifty. IT may continue to see some selling, or alternatively, you could see some low-level buying emerging for pharma and IT stocks. You've got 11 new IPOs and 14 new listings that will hit D Street this week, and frontline stocks will continue to see the buying, as FIs usually prefer that space of the market in trade. And with the kind of flows you've seen coming in on Friday, I think that space could remain pretty attractive.
Oh, absolutely. The close on Friday actually are astonishing, and this is something that we were talking about on closing on Friday, Samina, when you saw that big swing up just in the last bit of trade, that this is FII money coming in, and it was. You know, what I think would be interesting to see, or at least what I'm watching, is that will FIIs or global money coming in stray from the tried and tested? Yes, the usual suspects will get that interest, but I think you might see some sectoral stock rotation
just on
there.
Friday, Tamanna, I think I mentioned it already, but the reason you saw such a big number is because when London opened up, the FTSE All-World Rebalancing Index took place.
Yeah.
On back of which, of that 14,000 crore number, you had about $1 billion, which is close to 7,500, 8,000, that just simply got rebalanced and moved to India in a passive way. So it was one-off, but it was great because it took the markets to new record highs.
I think the implied open, once again, is something that we should pull up, because to look at whether you're going to see that momentum continue, and yes, absolutely, it looks like it's only getting better. So expect a strong start really coming in today. Let's go to some of the stocks that are on our radar, and a lot of news flow as is typical over a weekend. I'll start with Vodafone. Now, Vodafone has had a blow hot, blow cold kind of a situation going on. The big hit last week, of course, came from the Supreme Court decision to not review the method in which AGR dues are calculated. But after that, despite all of that hit, you might have an upswing in Vodafone today, simply because of what they've announced over the weekend, which is that they've signed a $3.6 billion deal with Nokia, Ericsson and Samsung. This is for supply of network equipment over the next 3 years. And the company claims it's the first step towards rollout of a 3-year capex plan of 55,000 crores. So why this will be seen as a positive, so the amount is not massive compared to how much a Vodafone would need to compete with the top players, is because the signaling going to the street and to investors is that despite the hit that we got from the Supreme Court's decision, we're not stopping or pausing or halting any of our capex plans. So that would be seen as at least a bump up for today. KEI International is the other one. New orders coming in of about 1,000 crores or 1,003 in the areas of railways, civils and cables. The year-to-date order intake, in fact, now stands at 12,300 crores. And you have to look at it from that perspective as well. KEI had a down day on Friday at a time when everything else was running up. So maybe you'd see that bump up today. There's been a 60% growth year-on-year on their order book overall, and 70% of this year's order intake is coming from the transmission and distribution business, is something that the company is saying. So you could see a move there. Another one, and I don't know if you'll see an immediate up move, but important to mention, Prime Minister Modi is in the US, and you know, a very important deal has been signed between the US and India. This one is really historic because it's a pact on India supplying chips to US armed forces. It's going to be a collaboration of 3 companies. India's first, and this is the Indian government doing this, right? So India's own very first non-private semiconductor fabrication unit, which will be supplying chips then to US armed forces and allied forces that they require. The size of it, the scale of it still has to unfold, but in terms of moving up the value chain for India in the semiconductor space, right now we were largely assembling, and most of our units are going into assembly. This one is big. So a CG Power, a Keynes Tech, because these are all in the space, could see a sentimental upswing today. A Dixon, a Tejas Network, VA Tech, Wabag. These are some of the ones that I would watch out for.
And these are been doing so well. I mean, Dixon has been the stock of the year, right? It's been signing deals on the roll. We talked to the management as well last week. So another good day for some of these semiconductor players in today's day of trade. I'm going to continue to add to Tamanna's list. BHEL has been beaten down and has had it rough for quite some time. But this time around, there's some good news coming in. The company has received a pretty significant order to the tune of 6,100 crores from NTPC for EPC package. And this could be a stock positive. Remember, BHEL did decently well on Friday in trade, but for the week itself, the stock has been reeling under pressure. So watch out for BHEL on back of this news. The stock could be seeing a bump up in trade. HDFC Bank, I know there was some reports of this on Friday itself, and we did see the stock react quite well in Friday's trade. In fact, it had a good session, gained 2%, with a lot of the gains coming in the second half of trade. But remember, you've had a whole lot of investors who've been waiting on the sidelines, and this time around, HDFC Bank, the good news here is, and this is formal, official announcement coming in, that the board of HDB Financial has approved its IPO, including a fresh issue of 2,500 crores. Big positive for the stock and stakeholders of HDFC Bank too. The counter could be one to track in trade today. Well, apart from that, you've also got Adani Total Gas. The company secured its largest ever financing in the city gas distribution business. They've entered an overall financing framework which will now enable them to secure future funding based on projects or specific business plans. It was about $375 million that has been raised through lenders such as BNP Paribas, DBS Bank, MUFG Bank, and Mizuho Bank, to name a few. So this one could be a positive only because it sort of charts out the funding and financing plan, especially given that the institutions that have come in are fairly marquee in nature. Another quick one I want to mention is HFCL. The stock is up 85% year to date, and this morning it could be a big mover too because they've developed and they will supply critical subsystems for unmanned aircraft with General Atomics. So big news, big development. We don't know the size of the order or the timeline, but in terms of announcement, this one becomes significant.
Yeah, HFCL again. You know, just the defense space overall, and in the last week, just look at how some of your defense names were doing. Cochin, Garden Reach, Mazgaon, all of them revving up once again, at least over the last week or so. HL maybe not so much, but look at a Garden Reach was 9% up, a Cochin, a Mazgaon, even a Bharat Dynamics was showing a good up move, and Cochin Shipyard was of course 10% up. So you might see defense back in focus, especially after some of the announcements that have been made on the US trip by Prime Minister Modi. But more stocks on the radar, and Mahima is joining us with more details on some others that you should watch out for. Mahima, including Motherson and SpiceJet on your list?
Absolutely. So Motherson and SpiceJet on the back of QIP. Now, board has approved an allotment of roughly 26 crore shares for the QIP, and this is at a price of 190 per share, and the total QIP amount will be at 4,938 crores. Now, the key allottees include ICICI Pru, Quant MF, Nippon Life, NPS Trust, and SBI Mutual Fund as well. The company has also issued compulsory convertible shares to SBI and ICICI Mutual Fund, and both have taken 48.33% each of total convertible shares. Now, in terms of SpiceJet, well, the QIP allotment has now taken place, and the board has approved issuance of 48.7 crore shares. The list of key allottees include Atham Investment and Infrastructure Limited at 9.33%, Discovery Global at 8.33%, Tro Capital at 6.67%, Society General at 6%, and Goldman Sachs at 5.3%. The next stock in focus could be Bikaji Foods. Now, the company has incorporated a wholly owned subsidiary called Bikaji Foods Retail. The company will venture into areas of cafes, restaurants, QSR, and catering overall, and the cost of acquisition comes out to roughly 1 lakh rupees. The next stock is Matrimony. Well, the company is set to launch new jobs business called Many Jobs. Now, this will focus exclusively on grey collar job market, and the company will initially launch this in Tamil Nadu market, both in English as well as Tamil. The last stock on my list is Tata Steel. Now, company successfully commissioned blast furnace at Kalinganagar, Odisha, and this will invest around 27,000 crores in phase 2 expansion, and this will increase the overall capacity from 3 metric ton per annum to 8 metric ton per annum. So these are some of the key stocks that should definitely be on the viewers' radar for trade today.
Okay, so those and some more. If I were to add, I'd also add an Amber, because important note out from Jefferies on Amber. That has maintained a buy with a target price of 5,200. That's a 19% up move, saying its AC vertical has a potential for a J curve to clock 17% CAGR right up to FY30. So they're very, very bullish on this stock. They also say strong growth prospects now for electronics industry with imposition of anti-dumping duty for Amber. They have a strong order book of over 2,000 crores, 2070 crores actually, in mobility and long term. So they are quite bullish on that. In fact, you might see a lot of impact today from notes coming in. But focus on the primary market as we always do. And Samina has got more details on the IPOs this week. Yes, Samina?
It's a busy week, Tamanna. You've got 11 subscriptions and 14 listings across the main board and the SME board. But what you want to keep in mind, today may not be as busy. You've only got one IPO that opens for subscription. It's a small one, but it is on the main board, and hence we must highlight this one. The subscription date of Manba Finance is today. It closes on the 25th of September, which is Wednesday. So between Monday and Wednesday, you could apply to get allocation to Manba Finance. Like I said, it's not a very large one. Recently, we've seen the likes of Bajaj Finance who've come in and raised to the tune of 1,100 crores or 3,000 crores. This one is about 150 crores, so 1/10 the size of the recent IPOs that we've seen. The price band of this one is 114 to 120 rupees as well. Well, more details on this one. They managed to raise about 45 odd crores through anchor investors. Chartered Finance and Leasing is their biggest investor that has invested upward of 10 crore rupees in through their anchor book in Manba Finance. Well, what we believe is that the company is going to use the funds to augment their capital base and to meet future capital requirements. So there's no immediate need of money that's required, but this will of course shore up their capital base for future business. Well, what is Manba Finance? Let's quickly tell you about this company in a nutshell. It's a Mumbai-based financial solutions company which offers salaried and self-employed individuals quick turnaround for loan sanctions. They specialize in the new and old auto loan segment and personal loans as well. So be it a two-wheeler or a three-wheeler, they do maintain a niche in that space. Well, as of FY24, they did have the largest share of two-wheeler loans, accounting for 92% of their AUM. Numbers were also healthy. FY24 saw their profits, AUM and revenue shoot up quite significantly. AUM in FY24 went up to 936 crores, up 37%. Profits came in at 31 crores, up about 90%. And revenue also saw a big jump at 191 crores, up about 43%. Well, so all in all, the numbers look good. The business model is healthy. We've seen the kind of response some of these finance companies have got, NBFCs in particular. This one is a smaller one, but focusing on a segment that has a low default rate as a whole. But there are a few risks. We'll highlight that for you very quickly. So be very mindful when you're making these investments in some of these new listings that we have. Their average yield is about 21%. It's very, very high and hence very, very healthy. But also because it's so high, it also seems rather unsustainable in the medium to long term. So while in the short term, they could continue to grow at a very significant pace, the fact remains that maintaining this yield could be slightly tough as the demand environment does undergo a change. Apart from that, 48% of its AUM growth that we saw in FY24 came in on back of a few factors that you want to keep in mind. It was a one-off gain from an asset recovery which has masked the concerns that the company may have in terms of its financial assets. It's also a rather expensive company to invest into. From what I understand, the credit rating is a BBB+, but the valuations are 1.7 times price to book, which is compared to its peers is on the expensive side. But that's what we have. It'd be interesting to see whether it gets picked up and gets a sort of response some of the recent IPOs have got, Tamanna.
All right, so Manba in focus. But you know, the interesting thing about the IPO frenzy is how investors and perhaps retail investors too are trying to find a way to game the system. And what I mean is how interest is increasing in parent companies in hope of a better allotment. So a lot of IPOs that are expected down the line have a shareholder category quota for the IPO, and which is why if a subsidiary is listing of a company that's already on the exchanges, then investing in it may help. So I'll give you an example. We've seen that with NTPC all of last week, because you have an NTPC Green that's going to list. You would see that with an HDFC Bank because of two companies, HDFC Fin Services and HDFC Credila. Hero Motor also in focus because of the expected listing of Ather Energy, and Hero FinCorp Motor. SJVN is the other one because of SJVN Green Energy is listing. Coal India is the other one which could see some kind of an up move because of this. Bharat Coking Coal is expected to list, and Canara Bank also on that list because of the expected listing of Canara Robeco AMC. So it's an interesting take about how, because of, and I think it kicked off with Bajaj Housing Finance, I would say, Samina, because of which everyone wants to find a way, right? You don't want to be stuck like when you didn't get Coldplay tickets. So you're like, let me at least get into the parent company and hope for some upside there.
Yeah, and it's not just, I think there's the other route that a lot of people have been looking at, and we've talked about this, is what we saw with NSE. So getting into pre-IPO allotments, that's the other big space, right? We've seen it with Swiggy as well. In fact, we were discussing this on Friday. The number of brokers that are recommending and pushing their clients to go out and buy into Swiggy prior to their DRHP being filed is also significant. And I guess thanks to these IPOs, our markets have not gone into bubble territory. There is so much of money on the sidelines, and one that seeks value, and hence the euphoria around these primary market listings. But talking about markets, and as they continue to scale new highs, market veteran Ramesh Damani says that the markets are, of course, in a sweet spot, and there could be some more that we could be getting from the markets. From the sidelines of the CFA Society event in Kolkata, he says that the market focus is tilting towards the large caps over small and mid caps. Take a look.
I think 5 years ago, when Nirmala Sitharamanji cut the corporate tax rate, the index was 36,000. It has doubled since those levels in the 5-year period. So it's a good time for us. Let's remember that the index has gone to 80,000 from 36,000 place out there. Having stressed that, I think the market is ending a new phase of the bull run, where the large caps, the mid caps and the small caps are leading the market, are now being transferred to the larger caps. So I would expect to see a movement in the indices, because clearly the large caps, if they lead, the indices also move sharply out there. And then at some point, the market will pause or correct, and we'll wait for that. But right now, it seems like there's a transition of leadership going on from the small caps and mid caps, which led the market higher, to the large caps.
And in that frame of things, we've recently seen the Fed cut rates by 50 basis points. What does that mean in terms of liquidity for EMs?
It's good. I mean, obviously, when interest rates go down in America, money becomes cheaper. So money then searches for higher returns. So India has already been a favored destination. I think for the last 6 months or so, foreigners and domestic have poured money into India. I think that will continue. I think you might also note in MSCI, we become the largest single weightage of a country. So all that tends to propose. And I think in markets, I've realized that what works even better. So as long as you're going up, more money will flow into India. So I think, given the fact the Fed has cut rates, is good for emerging markets and good for riskier assets like emerging markets.
In fact, we have a great number of voices from that event in Kolkata, which was over the weekend, and our colleague Pallavi had gone there, and you hear from Ramesh Damani, Samina, you hear from Vijay Kedia, and you hear from all of these people at a time when I think directionally to understand where the IPO space is going is very important. But just, to recap that, what are some of the key moves that you could see today? You should watch out for telecom once again, because that whole story is definitely not over. In fact, Jefferies, talking about telecom, and a Jefferies note out on telecom, also focusing on the kind of response that we've seen on the whole AGR issue. So they say that BSNL and MTNL are unlikely to pose a risk to Bharti and Jio in the medium term. And the reason they're saying is that because look at the data, subscriber data, which came out over last week, where BSNL has actually pipped all of the private players in new subscriber base. So telecom is definitely one space to watch out. But what else is in focus in the Indian equity space? We're going to be hearing now from Sanjay Mukim, Head of Equity Research, JP Morgan. Niraj is speaking with him. Take it away, Niraj.
In a scenario where growth is okay, that's the best situation for risk assets, right? equities conceptually are an asset class that benefit from low inflation and high growth. So if you get inflation coming off, which is where you get the rate cut, but growth is sustained at a reasonable level, asset prices will be supported everywhere. However, if the rate cut is happening because growth is slowing down significantly, then that's a very bad situation for equities or growth asset classes, right? I think the debate is still out which sort of a rate cut we've got. As of now, the market is of the belief that it's the former, that growth is fine, inflation's come off, it's great for us. And therefore, what we need to watch everywhere around the world, not just in the US to my mind, does growth hold up or not? Because if it doesn't, then equities might come under some pressure.
What's your prognosis about the India growth, therefore? And what are you telling clients out here? 1,000 odd people, you said, right? So what are you telling them?
Well, mechanically, our printed growth numbers will come off, right? And this is just the math of the base effects and the way the deflator is calculated. We've seen that in the June quarter, and that trajectory of it coming off a little bit mathematically is going to play out over the next 3 quarters. The only thing that's worth noticing is that India has had GDP upgrades in the previous 3 quarters, where printed GDP numbers beat everybody's estimates. This quarter, we've actually got a minor GDP downgrade, where it's come in lower than, let's say, the RBI's expectation. And this is reflected, if I may segue, Niraj, in earnings in the market as well. Whereas for the previous 3 quarters, earnings were beating estimates and we were seeing upgrades to, let's say, the Nifty or MSCI India EPS. This quarter, around results season, we've seen downgrades. 2 out of 3 companies have missed numbers, which is very rare for the first quarter. And we see a minor downgrade to the index EPS number as well. So on momentum of activity, whether it is through GDP or through corporate earnings, we've seen a minor deterioration in the market in the last quarter.
Okay, but if FY26 numbers, estimates out there look okay, let's work with that assumption. Are markets egregiously valued for you to tell your clients here that, hey, be very, very choosy about India despite the interest? Or do you reckon people will go out and say that India is amongst the few bastions of growth? I mean, Japan, Spain, India, maybe US, very few economies growing and very few economies showing earnings growth. So never mind the valuations, let's put in the money.
So again, you can make multiple stories out of this, right? If you look at the Nifty 50, the top 50 large cap stocks in India, the weighted average PE is exactly the same as the S&P 500, right? So there is no premium, there is no discount, and we've traded in line with the S&P for many years. So in the context of a global equity valuation, India is not overpriced on the large cap basket at all. Yes, individual sectors may look well above average, and you can pick and choose those kind of data points, but the index itself relative to equities in the US is fairly priced in a way. However, if you go down the rung, Niraj, and you start looking at stocks in the 101 to 500 or 500 to 1000, and you take various cuts of that, all of those are at all-time high PEs, right? And PEs are difficult to contextualize because of the narrative of growth. If you then back work on a DCF, or if you look at the implied equity risk premiums, etc., on a very mathematical analysis of valuations, the equity risk premium in Indian equity markets is at all-time lows, meaning that the amount you're getting paid for taking the equity volatility is the lowest that it has been in decades, and this means that equity as an asset class is reasonably overpriced.
Okay. So therefore, my question: are you telling people to be very, very picky, or are you telling people that still India will be good enough for your dollars to come in and get parked here? What's the message at the conference?
So look, we cannot tell people to stay away, because if they have a mandate to invest in India, if they have raised funds to invest in India, they have to invest in India. So telling people to not buy India is not really helping my investors. However, there are 2 or 3 points to make. If you buy at elevated multiples, the future return expectations have to be moderated. And let me give you a data point. If you had bought at the top of 2008, which was the top of the previous bull market bubble, even today, which is all-time high valuations, etc., your CAGR is only 8%, right? So timing of the market does depend or does drive future returns. So if you're buying at elevated multiples now, please keep your return expectations moderate. Yes, Indian earnings will grow better than other people's earnings and all of that, but don't expect a 15-20% CAGR in Indian equities for the next 5 to 6 years. You have to moderate your expectations of returns. The second point that we make, and this is slightly different from what you were probably talking about, is liquidity, right? And what always happens in every bubble, everywhere in the world, the first thing people forget is liquidity. And what this means in the equity context is, let's say you bought a stock today which is trading $30 or $50 million today. In a down cycle, your ability to sell the stock as a large cap institutional investor gets diminished significantly because the liquidity disappears.
Well, that was JP Morgan's Sanjay Mukim telling us about valuations and the role liquidity plays, which keeps stocks buoyed. But with that, we shift focus to the futures and options space. Well, it was a great week of trade. In fact, we saw the benchmarks hit yet another life high, close at those life highs as well, with a significant amount of longs coming in as far as the Nifty futures are concerned. Now, even as we move into this week, we have plenty of traction because remember that fund flows from the FII standpoint is extremely strong. And while we saw about 14,000 crores worth of inflows in cash markets and a substantially higher amount of flows from the FII standpoint in the futures and options space as well, we see the open interest increase of around 6% in the Nifty futures. Bank Nifty, on the other hand, which also did advance by quite a bit, saw unwinding worth around 9% in open interest. As we move into this trade this week, well, we're looking at a 500-point range, which has moved higher. That said, while we may face a little bit of resistance around the 26,000 mark, do remember that we're not too far away from that level, considering we close at 25,790. So about 210 odd points, which is less than 1%. To take out 26,000. So it is going to be something to keep an eye on as we move to trade today. But, as far as stocks are concerned, it was a day where a lot of frontline names ran significantly higher. And in fact, ICICI Bank making life highs, L&T, Bajaj Auto, HUL, all of them advancing in trade with good gains coming in with the longs as well there as well. Even in terms of stocks which saw unwinding, we saw about a short covering for Vodafone Idea, Balrampur Chini, as well as Kotak Mahindra Bank. So all in all, it was a good day of trade. But the question is that are there trading ideas at the moment which look interesting? Well, let's get in an expert opinion. We have Amardev Singh of Angel One who's joining us on the show. Amar, good morning. Thank you so much for joining in. What's the first stock on your radar that potentially could have some play when it comes to options at the moment?
Yeah, I would say the first stock is HDFC Bank. Because if you look at HDFC Bank, this is one stock which, despite having significant weightage in the index, was really not firing up. And what we've seen is that after a lot of consolidation, the stock is trading, because earlier resistance was around 1670, 1680. So that has been taken out, and the stock has delivered very strong returns last week of almost 4.5%. So HDFC Bank, one can look at a bull call spread for the October series, not for the September series, for the October series. So one can look at buying a 1740 call option October at 40, sell a 1760 October call option at 30. So the difference being 10, and the stop loss is 1 and the target is 25. Because once it has reached this level, there is a very high possibility that we could see significant higher tops being made in HDFC Bank. So this is the first stock.
Interesting, a bull call spread as far as HDFC Bank goes. The next one on your radar, Amar, I believe, is BHEL. Can you tell us what's happening here?
Yeah, see, overall, if you look at BHEL, what we've seen in BHEL is that the stock did correct after a significant and dream rally. From almost 335 levels, the stock is currently around 266. So this is a more of a, I wouldn't say a contra trade, because the long-term trend still remains up for BHEL, but it's taken some very strong support at the current level. So one can look at the October futures. October futures also one can look at the call option of 260 for the October series. But October futures one can look at with a stop loss of 249 and a target of 285 on the upside.
All right, Amar, we'll leave it at that. Thank you so much for joining us and taking us through those calls as far as futures and options space is concerned. HDFC Bank and BHEL, those are the two stocks which are on the radar of Amardev Singh. But with that, it's over to you, Samina.
All right, thank you for that, Agam. That, of course, is the setup. This morning, there's a lot of excitement, euphoria on the street. Activity seems to be back. With the FTSE All Index rebalancing, you had significant flows as well that came into our markets in the second half of trade on Friday. This morning, it seems like it's going to be a strong start. Whether or not 26,000 gets taken out is anybody's guess, but some profit booking at higher levels cannot be ruled out as we see it. Well, one stock that's had it quite rough, to say the least, has been Vodafone Idea. But this time around, we're waking up to some positive news flow that's come in for the counter. We have Richa who's standing by with more on that. Richa, there's some good news for the cash-strapped Vodafone Idea as they've signed a $3.6 billion deal with Nokia, Ericsson and Samsung.
You're right, Samina. So as you rightly mentioned, this is a good one for Vodafone Idea. Finally, after a lot of rough waters around, well, it has signed a $3.6 billion deal with Nokia, Ericsson and Samsung. Now, this is for the supply of network equipment over 3 years, and this marks the first step towards Vodafone Idea's plan of spending a capital expenditure of around 55,000 crore. Now, the company had announced this kind of plan later during the last year and earlier. Towards the start of this year. Now, this capex plan is targeted towards expanding its 4G population coverage from around 1.03 billion to 1.2 billion. Also, this is targeted towards launching 5G in key markets. Now, this will be helpful for monetizing the 5G towers and capital expenditure that the company has made. And number 3 is that this will help in capacity expansion, also in line with data growth. Now, the TRAI data had also come on Friday last week, which suggested that the population around the data subscriber is not that price sensitive, and this was supported by the data subscribers being consistent month on month versus a decline in the voice subscribers for the large telecom players. Also, the recent news around the AGR plea being rejected by the Supreme Court had a big hit on Vodafone Idea, because Vodafone Idea had around 70,300 crores in AGR dues to be paid versus a cash balance of 535 crore rupees. But this kind of deal signing is positive for Vodafone Idea because it is a first step towards the 5G monetization and 4G expansion as well.
All right. Thank you so much for that, Richa. So let's see if Vodafone Idea gets some reprieve today. But a lot of stocks that are on NDTV Profit's watch list, and let's quickly take you through them. What to expect today. All right, Dr. Reddy. On our radar, they have got zero observation at their Hyderabad R&D unit. Mankind Pharma, they've approved 10,000 crores via NCDs. Adani Total Gas has secured $375 million in financing. That could be an upside for the company. BHEL has won a 6,100 crore contract from NTPC. That's a pretty big one. You can expect a move on the stock.
Well, you've got Vodafone Idea, like we highlighted for you this morning. There's some great news for the counter. Of course, after a very rough last week, they've signed a significant deal to the tune of $3.6 billion. HFCL, the stock is up 85% year to date. And again, they've now signed a deal with General Atomics, so big gap up can be expected on the stock. HDFC Bank, this has been in the works for quite some time now. There were some parts of the market that believed this was going to be announced on Friday. The stock went up. The news is confirmed that HDB Financial IPO will be launching soon. Two stocks that could have it rough is Aarti Drugs. 7 observations from the US FDA on their facility. The counter could see some selling on back of that. And Dreamfolks, there has been some sort of a snag in accessing their airport lounge.
Yeah, they in fact had lines queuing up at airports because their entire technical issues piled up. Anyway, Soni Patnaik, JM Financial Services, with us this morning. So is Chakri Lokpriya of Red Strawberry. Welcome to both of you. And it's looking like we're going to have a massive Monday after a fabulous Friday. I mean, just let me pull up the implied open once before I get to Soni on the levels expected for this morning. Very strong. On the back of maybe the kind of flows we've seen. And some debate out there whether this was only because of FTSE rebalancing, but this is actual money that has come into the Indian market. Soni, what do you reckon? What is the distance to 26,000 looking like? Or are we being a little premature in talking about it?
Hey, good morning, Tamanna and Samina. Thank you so much for having me on your show. So I think it's no surprise that we may test 26,000, all eyes on 26,000, whether we are able to cross that level and see another 100 points above the 26,000 mark is going to be quite crucial. If you look at the option metrics, the highest open interest on the call side are actually placed around 27,000. However, considering that this is the final expiry week for September series, rollovers will also take over beginning from today. So anywhere between 25,800 can act as a strong support for intraday. Above that, it may consolidate till 26,000 if it's not able to sustain above that mark. The crucial support for the entire week or for the next 5 to 6 days, it's quite important to watch the 25,600 mark. If it's able to cross below it, then there can be some profit booking. However, I feel that any dip you see towards 25,800 also can get bought into, keeping a stop loss of 25,600. Not to chase today's gap up, it's wise if somebody would have already bought it from the last week levels, book around 26,000 and sit tight. Focus on stock-specific strategies. This is about Nifty. A bank Nifty, on the other hand, looks still strong. It may test 54,000 before showing you any signs of profit booking. So I think bank Nifty, if somebody is already holding at lower levels, continue to hold the longs in bank Nifty and head for a target of 54,000 around which one can book profits. As of today, it is wise to stick to either bank Nifty for a long trade, or you can stick to stock-specific strategies. Do not chase Nifty in the gap up.
Chakri as well joins in with a fundamental view on the markets. Chakri, how are you feeling? Till yesterday it was all about Indian markets being expensive, activity being restricted, lack of upside triggers post the Fed rate cut. But Friday came and so the markets record new highs. From where we are today, where is your bias? Are you cherry picking in the broader markets, or is it large cap space that you're attracted to?
I think there is enough to buy within both the large cap and the mid cap space, because as far as the index is concerned, probably trades about 20, 22 times, depending on how you look at earnings. That's not really that expensive in this point of the economic cycle, where you're just before a rate cut happening in India. Now, after the pivot in the US, clearly RBI will also turn. It's a question of time. And the rates will need to fall quite significantly over the next 1 year or so. And you can see that all the manufacturing companies, financial services companies, and some of the consumer durable companies will benefit from this move.
Well, that is the call coming in on the markets. Opportunities are lots as per Chakri, and they sit across the broader markets and the large cap space. Well, implied Nifty is indicating to a solid start this morning, about 10 minutes to go to pre-open trade, but we've got a bunch of brokerages that we should be tracking in trade. Jefferies, I believe, maintains a buy rating on Amber Enterprise with a pretty significant upside of nearly 20%. Puneet is joining us with more on that. Puneet, what do we have?
Well, yeah, thanks for that. So it is a 20% upside, target price of 5,200 on Amber Enterprises. And, Jefferies has mentioned that, the domestic AC industry has been very strong in Q1, which has been because of heat waves as well as, a lot of demand for AC products. Apart from that, imposition of anti-dumping duty on PCB specifically has been a very big boon for Amber, as they have inducted new clients because of this imposition. Now, the industry will likely, the company also has a strong order book of about 2,000 odd crores, which gives strong revenue visibility going forward with long-term prospects, of course. Now, the domestic AC industry sales for the industry stood at about 1 crore and is expected to rise to roughly about 1.3 crores for FY25 specifically, which indicates a 30% volume growth for the industry and bodes well for someone like an Amber Enterprises. They have mentioned that, the AC vertical has a potential of seeing a J curve as well by FY30, and this 1.3 crore number is expected to reach roughly 3 crore ACs by FY30 with a CAGR showing of about 17%. Now, the company specifically is expecting to clock a 45% growth in FY25 specifically, and they are seeing that with normalized capex of about 300 to 400 odd crores for the next couple of years, ROC is expected to reach roughly about 20% by FY26. Finally, stock trades at about 37 times its FY26 price to earnings, and Jeffrey believes that they will be able to retain this based on the company's 5-year average. So overall, really positive report on the industry dynamics as well as Amber's positioning in the same. Back to you.
Okay, so Amber on radar, as we had mentioned. Thank you for those details, Puneet. Soni, what are your top picks this morning?
Tamanna, the first pick is in Trent, which has given a good short covering move on Friday's close and a very strong breakout above 7,400. So one can buy Trent for targets of 7,600 to 7,640, keeping a stop loss of 7,400. The second pick comes in from the realty space, which has seen a good breakout. That the stock is DLF. Now on Friday, we've seen a very strong bullish engulfing candle pattern close for DLF. It has given a strong breakout above 860 level. It has very strong support around those levels. One can buy DLF around 875, keeping a stop loss of 865. A target of 900 and a follow-up target of 910 can be seen.
Sony, that's a buy call coming in on DLF. Sony, what are you doing with HDFC Bank? There is a fundamental news trigger. The stock went home at its day's high point. And it's been 5 years that the HDFC has underperformed Bank Nifty. Do you feel now could be a time when most people are circumspect or have been reducing their positions on HDFC Bank? It could outperform. Would you buy HDFC at 1741?
Samina, HDFC Bank has given a good breakout. If we look at just the option chain data for HDFC Bank, above 1720 is a good option chain breakout that has come in. If we want just a short-term trading perspective for HDFC Bank, anywhere close from 1710 as a strong support on the higher side, one can see it testing higher towards 1760, 1770 levels. Now, if you want somewhere between a medium to a long-term view for HDFC Bank, one can definitely continue to hold the stock with 1600 as a stop loss, and the targets for the stock can be seen towards 1900 to 2000. So I think it's quite wise. It's in a good level to accumulate and hold for a medium-term level for targets of 2000.
Chakri, very quickly, what do you feel? I mean, mutual funds for the first time in history have reduced their positions on HDFC Bank pretty significantly. And if you look at historical data, HDFC Bank has largely been an underperformer as compared to the Nifty and even compared to Bank Nifty. Do you feel the time has now come for HDFC Bank to turn the corner?
I think, other banks like ICICI or even troubled banks to an extent like RBL, they're going to do a QIP, are better positioned. For the simple reason that HDFC Bank still has to work itself out of its merger-related costs, which will still take time, and its valuations kind of are not inexpensive. So until there is a trigger of renewed growth that we'll see from HDFC, we'll still stay away from the bank.
Avoid HDFC Bank. There are better opportunities in the market. Chakri believes counters like ICICI Bank might provide a better risk reward. Let's not forget that ICICI Bank hit a record high on Friday in trade. We'll take a break. We'll come back, track pre-open and gear you for market open. So stay tuned.
back. You're watching India Market Open, and we are just 20 seconds away from the pre-open session. Expect a really good opening. The question is that can it sustain? And Chakri and Soni with us this morning to talk about what they are liking in this space. Chakri, I want to talk about the whole semiconductor story and how much of it do you think will lead into sentiments today? We had a pretty massive deal which was signed during Prime Minister Modi's trip to the US. Do you think a Keynes Tech, a CG Power, a Dixon are some stocks and stories that you would look at today, considering that India is going into its own first fabrication unit and will supply to US defense?
Morning, Tamanna. I think you're absolutely right. These are very early days for the Indian semiconductor industry and its growth path, and therefore, the valuations will always kind of look expensive, but the growth rates of each one of these companies, whether it's Keynes or Dixon's, these companies will grow very fast. They're 40-50% revenues over the next several years. And, the profitability clearly will be lower. There's an initial capex phase, but that shouldn't stop one from investing. So I'd clearly go and buy a company like Dixon's. Keynes has already run a bit, maybe a CG Power. And, even all the other companies like Amber, they're not directly semiconductor, but they'll all, that whole ecosystem will benefit.
All right, I just want to look at some of the pre-open buzzers and Vodafone on radar. We talked about this on our stock list as well. They have announced a pretty significant capex move with 3 companies. They're tying up with 3 hardware companies to expand capacities. That stock has been down and out, about 10% up in trade today. I want to see what Indus Tower is doing as an extension of the interest in Vodafone this morning. And Indus Tower also about 4% up in trade. What's in focus? Adani Total is in focus. Finance details coming in there, and that perhaps is helping. BHEL in focus. Pretty much everything that you would have seen on NDTV Profit's watch list this morning. That NTPC deal is perhaps helping as well. Some of the steel counters, Ratnamani, let's see, Tata Steel, some of them also in focus today. But Sonia, I want to come to you on Vodafone, because this is a stock which is owned in fairly large quantities by retail investors as well. A lot of them wondering which way the wind is blowing.
Tamanna, on charts, stock definitely looks quite weak because it has broken below its 200 EMA on a positional basis. So even if there is a bounce back towards 12 or 13.5, it may just be used as a space where one would like to dump people, position. So I think it's quite weak, and there's no signs of any sort of recovery or a bounce back at current levels. Stiff resistance around 13.5 to follow.
What about you, Chakri, on Vodafone? Does the recent announcement where they have a $3.6 billion network equipment deal, and big players there, so basically they're buying now from Nokia, Ericsson and Samsung over the next 3 years. Does that enthuse you in any way or give you some confidence?
No, I think we'd still stay away from Vodafone simply because of the adverse Supreme Court ruling, which I think is clearly negative for the entire industry. Telecom industry, 70,000 crores from Vodafone has to pay, kind of, dwarfs the new order that they have won. And this capex of 58,000 odd crores is over and above the 70,000 crores now that they have to pay to the DOT. So I think, and even Bharti for that matter, it still has to pay 40,000 crores. So I think the whole, both these companies are clearly an avoid.
Right. Soni, a couple of other stocks that haven't participated last week, in fact, sold off for stocks on the tech pack, oil and gas and pharmaceuticals. Do you have anything across these 2 verticals that look ready for a bounce back this week across IT, oil and gas and pharma?
Samina, if we talk about the IT space, I think there could be still some more selling on a downside left. stocks on the space, large cap stocks are actually looking quite fine. If you just accumulate on dips of around 2 to 3 more % of a correction and accumulate in that correction, the stocks can bounce towards another 5% to 8% for a medium term position. So it's wise just to collect them on dips. So if we talk about specifically stocks like TCS, 4,000 is the level which is a very strong support. Now the stock is somewhere around 4,200, 4,300 levels. So let's wait for the support to be breached around 4,000 for one to buy on those dip levels. Now if we talk about pharma space, I think pharma, clearly Sun Pharma is one stock which has been standing out quite strongly, and it still shows signs that there can be another fresh breakout coming in. So Sun Pharma is the stock to watch out for. It can test 1900 to 1920 levels. 1840 is a very strong support. If you look at the oil and gas space now, in those sectors, in that entire sector, BPCL is a stock one can look for. It has given a good recovery on Friday's close. There's an immediate support of 320. If BPCL holds above 320, it can bounce towards 350 odd levels.
Sony, another quick one that I want a quick view on is Hutco. After a very rough week, it did quite well on Friday. Do you expect follow-on buying in today's trade on Hutco?
Definitely, Samina. I think Hutco 260 is a resistance which is around its 20 EMA level. So if it's able to cross that level, you can see it heading to higher towards 280. One can hold on to the stock. It has bounced exactly from its 200 EMA support, which is quite strong. So hold on with stock. If you see any small dip towards 245, can buy on those dips. Keep a stop loss of 235 and a target of 260 to 280 can be seen.
Right. Well, talking about stocks and what's going to bounce, but also what brokerages are constructive on, CLSA has come out with a note on urban consumption, highlighting the changing trends. Mahima has got more details on that. Mahima, what do you have? CLSA believes and has an opinion on something on the lines of trends that are changing in consumption.
Releases. I mean, it's a very interesting note, and they've said that consumption trends are changing, and Zomato is the best way to play this theme. Now, what they're saying is that over 1 lakh people were ahead in ticket queue for a $50 to $400 range of tickets, and Diljit concert sold out 250,000 tickets at an average price of $90. So, and similarly, concerts of Coldplay, Dua Lipa, as well as Bryan Adams were also sold out rapidly. So this suggests that all 4 concerts saw a sale of roughly 3.5 billion to 4 billion, which is over 40% incremental quarterly sales of listed QSR. So what they're saying is that consumption for older companies might be misleading indicator for consumption. Events like travel, eating out, luxury and premium goods is something that is really picking up and is emerging as preferred areas of spend, and QSRs are struggling, but Zomato and Swiggy food delivery platforms are chugging along. What they're saying is that the gross order value for Zomato's food delivery business continues to grow at a pace of over 25% for several quarters, while QSR have been struggling with growths of single digit as well. And Zomato's dine out business, while is a smaller portion of as compared to the delivery business, but it has more than doubled in Q1 FY25. They're also saying that data points from Nykaa, Make My Trip trends suggest that consumption remains robust, and this consumption trend is different as compared to FMCG companies and QSR companies, which have been seen as weather so far. So overall, what they're saying is that Zomato is well placed to tap the increasing demand for consumer experiences.
Some context to why there was so much interest on this, which is literally what we saw over the weekend with a craze for Coldplay tickets. At one time, nearly 1 lakh people in queue wanting to get those tickets. We saw that with Diljit Dosanjh short time ago. So if you are now someone who has experienced this over the weekend, talk to everyone about it and wondering what's the stock market play. The stock market play, according to CLSA, is Zomato. So that's the long and short, essentially, of what Mahima is saying. But I'm going to come to Chakri on that point. The consumption story and Zomato as a proxy for it, considering that it has already run up a fair bit.
I was in the queue for Coldplay also, and there were some 300,000 people ahead of me. Unfortunately, didn't get the tickets. So, companies like Lemon Tree, people will travel to visit and stay in the hotels to watch the show. These are not the 5-star hotels, but, a couple of steps below. So, and then, kind of look at as we are going into the festive season, while QSR might have been down and out. But again, companies like Devyani, they'll all come back during Diwali, Navratri, all those times when the festivities increase. So I think, yes, consumption in terms of the hotels is one way to invest, and some of the QSR plays.
What about you, Soni? How are you feeling about a Zomato? How are you feeling about a Trent? How are you feeling about a Lemon Tree, since Chakri also mentioned Lemon Tree?
So Tamanna, Trent, we've already discussed in the morning. It was one of my picks. Now, if we talk about Zomato on charts, one can see it has given a very strong breakout. It is just continuing with volumes even for today. So it can test around 305, 310 in short term with a very strong support of 285. So one can continue to hold the longs for a higher targets of 305 to 310. I think that's the stock to look out for. Even on charts, it's quite strong.
Zomato, and it's been on a roll. I guess the party will continue until Swiggy comes and hits the market with the listing in the next 6 to 8 months. That's the story on Zomato. A quick check on how pre-open is wrapping up. It's looking like a good start. Not as great as implied Nifty was indicating too, but a comfortable start, about 25,800 is what we are anticipating in early minutes of trade. 80 points higher on the Nifty 50. A couple of other names that could be in focus today across the Nifty 50, and you've got the breadth that's not looking too bad, is going to be Tata Steel. Soni, do you track Tata Steel? And beyond Tata Steel, anything else in the metals pack that looks constructive at this juncture?
So, Samina, if we look at Tata Steel, I feel that, 150 is an immediate support. Now, if it holds 150, it can attempt to take out the resistance of 156 for the day, which is going to be very crucial because that's where the 50 EMA is placed. Any move above 156, the stock can head higher towards 160 for a day or two sort of a move. One can continue to hold longs in Tata Steel with 150 as a stop loss. The other stock, which is looking quite strong from current levels, can be Vedanta. However, there's a resistance in Vedanta. There'll be a conditional buying Vedanta only if it crosses 460. One can look to buy in that stock for targets of 480, and then one can keep a stop loss of 450. At current levels, just wait and watch for Vedanta. However, at current levels, Tata Steel certainly looks like a good buy.
So Vedanta, Tata Steel, some of those coming in. I just want to understand, Chakri, how you're feeling about metals, and of course, including and not only, but including Tata Steel, and what else are you looking at in that space?
In a rate cut cycle, which we are going to embark on, and US has already started, India will come, but metals always benefit, but also there's the Supreme Court ruling which has put fines on all these various steel companies. Tata Steel has to pay, I think, about some 17 or 20,000 crores, whereas companies like JSW Steel, Vedanta, they don't have those fines. So the way we'd go about metal and mining companies is the ones where there is no Supreme Court ruling, which is JSW Steel, Vedanta.
All right. Just a couple of minutes left. Soni, want to know what is your one top pick this morning at a time when, maybe pre-open is putting a bit of a dampener on what we expected the markets to look like. But we'll wait. We just have about 2 minutes to see what really happens. What would be your one top pick at this point?
Tamanna, for today, I have my eyes on ICICI Prudential. Now, the stock has been in range of 750 to 770, 772 and has not broken either side of the levels. I'll be keeping a close watch in the stock. If it breaks 772, it becomes a good buy for a target of 800. And only above that level, you can buy, keeping a stop loss of 760. So that will be the stock to watch out for today.
ICICI Prudential. What about a BHEL, Chakri? Would you go in for a BHEL? It's roaring pre-open.
I think so. BHEL is now for a fresh lease of life. You look order book for the next 3-4 years is like some 2 trillion rupees. And so even if they do that 700-800 billion per year, which they are, this new order is about is pretty much allows them to reach that. So which means BHEL, after all this, trades only at about 25-30 times for the kind of order book growth. And therefore, yes, clearly, yes, buy.
Right, BHEL, that's a significant order, 6,000 odd crores. From months of underperformance, this could bring some relief to the counter, and the stock is seeing an uptick in pre-open trade. A start with a 3% gain is what we should be getting. Well, the markets as whole as well, the Nifty's next stop is going to be 26,000. We would be in kissing distance off that today at some point, but it could be a morning where we will consolidate with a small positive bias. Remember, it is going to be volatile. It's F&O monthly expiry as well, so it's par for the course. The markets will remain a little bit more volatile than usual. You've also got activity in the primary markets, 11 new IPOs, 14 new subscriptions. It's a busy week on the SME and the main board across the primary market universe too. But of course, the broader markets and the benchmark itself are expected to get a gap up. From here on, it's largely going to be global triggers up until the end of September, post which the first week of October will see the earnings season kick off. That will provide the next leg or direction to our markets. It's a start. It's a good start. It's a positive start as expected. Implied Nifty was truly all over the place with a gain of about 130 points, but that's not how it's played out. But we've opened comfortably about 25,800. A 60-point uptick on the Nifty is what we have. The Sensex also trades with a very clear positive bias. So you've got about 0.25% higher on the Nifty 50. Remember, it is going to be a day of consolidation. Don't expect fireworks for today's day of trade, largely because you've done so well on Friday that even the bulls will want to take stock of the situation before they initiate fresh positions. Bang Nifty, as I indicated, it could be a day of profit taking after having rallied up so well over the last 2 weeks. It's up nearly 7% in the last 2 trading weeks. Bank Nifty may see some profit taking emerging in today's day of trade, at best consolidation. Well, across the broader market universe, the breadth of the market is also relatively strong. So of the Nifty 50 stocks, pre-open was indicating to about 45 to 47 counters trading higher. If I can quickly get the spread across the Nifty 50, that should be helpful. But broader markets that have underperformed the benchmark over the last couple of weeks are actually playing catch up as expected. Well, that is the Nifty 50, not doing too badly. Pharma is making a comeback after losing 3% last week. There's some buying emerging at low levels across the pharma pack. Auto continues to do well. You've got some of your financials that are holding well together as well. ONGC on back of the movement on crude is doing okay. HDFC Life, Tata Steel on back of positive news flow is having an up morning. Defensives generally not doing too badly in trade. On the sell side, IT still looks relatively weak, so the profit taking continues with the IT pack, but cannot be ruled out that IT may see some low-level buying, just like Pharma has seen in early minutes of trade. Hindalco is slightly soft, and you've got ICICI Bank that's easing off from its record highs that were hit on Friday. Tamanna, a morning of consolidation. I think even the bulls have caught surprised with Friday's up move. So I think take stock, sort of reinitiate fresh positions, but until then, it looks okay, I think.
I think after a marathon like that, you can take a break. But, you hit 25,900 on the Nifty before retracing. So remember, you have opened at record highs. No taking away from that. It's a fabulous morning. Auto stocks, of course, are ruling the roost. Goldman Sachs note on Mahindra & Mahindra possibly contributing to the excitement there. But others along for the ride as well. M&M, Bajaj Auto among the gainers there. Infra, Pharma, Realty are some of those. So you're seeing the theme that we saw from Friday continue, which is that rate sensitives are ruling the roost overall. So auto and realty in that theme. On the downside, Nifty IT, but not massively, I would say. Nothing too much to complain. And the bank Nifty not really contributing and coming in. Now, if that happens, then you could see a 26,000 today. But then let's get into specifics. I want to just quickly pull up the broader indices once more before we go, because you're seeing the Nifty lose a little bit of steam, struggling to stay above that 25,900 level. But the mid-cap 150 also now losing some of its luster. Let me come to the small cap index. That's about 0.5% up. All right, stock specifics. Vodafone, Indus Tower. This was on top of our stocks to watch list, simply because of the kind of investment they've talked about after a very, very tough week in terms of news flows. So they have inked deals worth $3.6 billion with 3 major, Samsung, Ericsson and the like. for hardware, which they will spend over the next 3 years. That capex is going to come in. Positive sort of indication to the street that the adverse decision by the Supreme Court doesn't stop their capex plans. Having said that, about 6.5-7% up on Vodafone. Indus Tower, to whom it owes money, is also about 4% up. BHEL and NTPC is another pair of stocks that I'd like to look at this morning, because there's a 6,100 crore that BHEL has got from NTPC. It's not roaring as much as you would expect as far as the BHEL is concerned. A bigger up move in the pre-open session, but NTPC about 0.5% up. Adani Total also in focus this morning. $375 million of financing, international financing, has been inked and announced, 6% up on the stock this morning. HFCL, I mean, exact details of that deal are not known, but it really looks interesting because they're going to develop critical subsystems for unmanned aircrafts. They're working with General Atomics on it, 4% up on that stock. KEI International is the other one, and we'll be talking to the management as well. Ahead, 1,003 crore of order wins for KEI International. So these are some of the stocks that are moving this morning, but I'm sure, Samina, not a tough time today finding winners.
Yeah, it's a good looking Monday morning, right? So there's no rally, there's no runaway gains, but there are no losses. The breadth is healthy. It's taking stock after the recent run up that the street has witnessed, and global cues are also fairly muted. Well, the Nifty itself is trading flat as we see it. You've got a few movers. So Mankind Pharma, their fundraising plans were expected to be to the tune of 9,000 crores. They've got an approval for 10,000 crores. The stock is reacting well, trading with a very clear positive bias. Adani Total, a 6% up move on sealing the deal with some very significant marquee investors today. Pharmaceuticals, as we'd expected, are seeing a bounce back after seeing weakness over the last couple of weeks of trade. You've also got a few more names that are looking okay. So fertilizer counters also not doing too badly. Some of the auto anchors are having a positive day. Zomato, if Tamanna has probably mentioned that too, is having a positive session. On the sell side, you've got Godfrey that trades lower. Rail companies that were doing well on Friday, like Rail Vikas Nigam, are seeing some profit taking. Defense counters too ran up quite well on Friday. In fact, were one of your top gainers last week, are taking a backseat this morning and seeing profits being taken at higher levels. So all in all, it's looking like a stable Monday morning. Sony, anything that stands out for you as we see market open? As expected, pharma is bouncing back today. Anything that you've spotted? I know we talked about this before the markets opened up, but post-opening, anything that you like?
Samina, the first would be a continuation in DLF, which is up about 1.5% from the recommended price, and I think it can test up to 900-910 targets by day end today. The second would definitely be from the auto space. I think Bajaj Auto is a stock which is just continuing in its uptrend and looking quite strong. Even at current levels, it has crossed above 12,000 once more. So keep a intraday stop loss of 12,000. The stock can test 12,400 and 12,500 targets in cash levels.
Chakri, what about you? Are you buying into any of these pharmaceutical names? I mean, there was enough and more excitement around it. And with the US elections around the corner, it seems there could be some policy impact on pharma companies.
There could be, yes, but we're staying away because I think there's more growth. For example, Mankind Pharma, clearly there are enough growth levers out there. The valuation is decent enough, and there's sufficient runway for growth. But outside of that, we're not looking at it as a sector because we think there are enough in the rate sensitives like autos, banks, manufacturing. And so that's where our focus is.
So pharma in focus. I want to talk a bit about autos and what's happening with autos. Some brokerage notes may be moving it along there, but Chakri, let's talk about M&M, let's talk about Bajaj Auto, let's also talk about, a clutch of others, TVS in the two-wheeler space, Maruti, Tata Motors. Are you feeling love for all of them today, or is it more about M&M and Bajaj Auto? Samvardhana also jumping up there, but do you think that this rate sensitives kind of a mood will sustain with autos?
Yes, indeed. Bajaj Auto clearly will continue to benefit. The rate cycle has not started yet. Whenever it starts in the next month or two, then clearly it will continue to benefit and take market share. Newfound love and escorts, your farm equipment, and now they have a wider range of products after the Kubota deal. And so I think, and also the valuations are very well intact. Balance sheet is very strong. So it's escorts and Bajaj Auto.
Finally, OMCs aren't doing too badly in early trade. They've had weeks and weeks of underperformance. Even when crude prices were moving lower, BPCL, HPCL, IOC were not seeing the buying. Today, for a change, a little bit of green. There's no runaway rally here, but anything on OMCs that you would consider initiating? Sony, that question was for you.
Okay, so I think, Samina, OMCs, we've already discussed in the morning. Around BPCL is the stock that I'm still keeping a watch. It is just closing in on the 50-20 EMA hurdle, and it's got a good support around 320. So hold the stock with 320 as a stop loss. It can test 340 intraday. Now, if it's crossing the 340 mark, you can see it heading higher towards 360. The risk reward is quite favorable. Support is strong around 320. Hold the longs for a higher target of 360.
So those are the OMCs in play. A whole lot of other movers this morning. I just want to talk a bit about HFCL, and as more details of that deal are, of course, awaited. Sony, are you liking HFCL on the charts?
Certainly, I think it's also an official recommendation given by a technical desk on Friday. The stock is looking quite strong. It can head higher towards 175, 178. It's given a good breakout also. For intraday, if somebody wants to buy, you can accumulate on small dips around 165 to 162. Keep a stop loss of 155 and a target of 175 to 180 can be seen.
Sony, I remember last week when we'd spoken, you were fairly constructive on Tata Power. The counter failed to see a breakout, but surprisingly, I have you this morning and we're seeing pretty solid volume moves on Tata Power. It's up about 1%, so in percentage terms, not very high, but it's moving significantly on volumes.
Definitely, yes, Samina. Tata Power is actually consolidating. The higher end of the consolidation range is just around the corner. It's around 450 to 454. On the downside, there are multiple support levels, but the one that's crucially standing out for is around 435. Now, if it's able to cross above its resistance of 452, 454 for the day, you can see it heading higher towards 470, 75. So continue to hold the stock. It's just consolidating right now. Keep your stop losses at 435 and look for high targets of 470, 480.
That's a hold coming on Tata Power, and as we speak, it's getting closer to 450. As we see it, 1% higher on Tata Power in early minutes of trade. A few more counters that stand out as we see it, and you've seen some sort of activity picking up on the broader market universe, is Glenmark, that's up 7%. That's a big move. Adani Total, 5.5%. Mankind Pharma is looking good. Suvain Pharma is looking good. ACT is looking good. Very quickly on Adani Total, Sony, how do the charts look?
So Adani Total on charts is looking decent. It is also consolidating. As we can see, the broader range of the consolidation can be seen. On a higher side, 845 is a resistance. On a lower side, 800 is a good support. Now it has to move above 845 to see any further move towards 880 to 900 odd levels. Hold the stock and accumulate at current levels, but keep a strict stop loss of 800. Look for the higher targets of 900.
Okay, stay on with us, Sony and Chakri. Meanwhile, we're just about 100 points away from 26,000. We've actually hit 25,900 and retraced a bit, but this could be an interesting day. Meanwhile, one stock which is not having a good day is Fusion Microfinance. Harsh is joining in to tell us why. Harsh, I believe they've met with analysts and had management rejigs as well, which the street is not taking too kindly.
Well, yes. So, Tamanna, It's largely on the back of a board meeting they had earlier this weekend on the 21st, where they've acknowledged that asset quality will continue to remain under pressure. This is a company which has faced its set of asset quality issues in Q1 FY25. We've seen 13% credit costs, nearly 350 crore worth of expected credit losses booked in Q1 of FY25. Now, what they seem to be suggesting is headwinds continue. Q2 FY25, the numbers will be much worse than Q1. Around 500 to 550 crores of credit loss expected to be booked in Q2 of FY25. They've also they're looking at changing some of their internal processes on the back of this, lending processes. They believe that the book continues to be under pressure, and therefore that is need of the hour. The other piece is Mr. Sachdev, who's the MD CEO, has suggested more executive leadership, and on the back of that, he might eventually step down as CEO and become the chairman of the company while giving way to a fresh new CEO. And that will also be a sort of overhang, because there may be some bit of leadership change as well, coming at a time when asset quality issues are persisting. Third, they are looking at a fundraise as well. Now, this is a company with a capital adequacy of 26%, so very well capitalized on a 12,000 crore loan book, 26% capital adequacy, and they're looking at a fundraise. Clearly not looking good, at least at the outset, basis announcements and basis all of this that has come through post the board meeting.
Okay, so yeah, 8.5% down on Fusion Micro, and that's I think one outlier which is definitely not having a good day. But you know, Soni, I want to come to you now that you've seen the first few minutes of trade, about nearly 15 minutes of trade settling in. Do you have a fresh set of stocks that you're seeing poised for a breakout today? Anything that you're finding interesting?
I think, Tamanna, we've discussed Bajaj Auto, we've discussed Tata Power, ICICI Prudential, but as of now, we keep a watch on, SBI. It's not exactly giving a very strong breakout. It's just bouncing back. There's a 20 EMA hurdle for SBI at around 798 to 800 odd level. Now, if this level can cross, there can be a short covering in SBI, which has underperformed to the rest of its peers. But it's a stock to just watch out for, and any move above 800, 805, you can see it heading higher towards 820, 830 odd levels. There's good support of 780 as of now. The stock is just consolidating. Keep a watch in SBI above 805. It can be a good short covering buy towards 825.
What on the bank Nifty? Because we're seeing the Nifty looking fairly strong, holding up as well, Soni. But the bank Nifty not really participating. Do you see the chances of that changing today?
I think Bank Nifty on expected lines, 54,000 was supposed to test. It's already made a high of 53,900 plus levels. This index is quite strong. There's good support. Intraday 53,300 is the support. Continue to hold in the longs for Bank Nifty. There's a possibility of it crossing the 54,000 psychological resistance mark. Above that, you can see it heading higher towards 54,500 as well. Remember that Bank Nifty Wednesday would be the final expiry. So the rollovers will start counting for Bank Nifty from today onwards, which is going to be very crucial. So there's a possibility of the rollovers happening at a higher levels towards 54,000 plus levels.
Right. Thank you for that, Soni. In fact, your Tata Power recommendation is actually doing quite well. As soon as you highlighted it, the stock is up nearly 2% as we see it on healthy volumes. Thank you, Soni. Thank you, Chakri. Great having both of you and talking to you both about the markets this morning. But one company that's been in the news for all the right reasons, of course, has that game changer drug in trial, which treats multi-drug resistance, WCK5222. And that's, of course, from the Wockhardt stable. Habil Khurakiwala, founder and chairman of Wockhardt, joins in to talk to us more about it. Hi, Mr. Khurakiwala. It's Samina joining in. This drug, we've talked about this so much in the last couple of months, and every time we speak to you, there's always some good news about WCK5222. I believe you've had and you've met with some success in treating a meningitis patient. You want to walk us through what this study was and what the outcome of this testing was?
Thank you, Tamanna. This meningitis case is a part of the compassionate use 5222, which is being used. And this was a meningitis case, and treating a meningitis is extremely, extremely challenging, where all other antibiotics, new ones also were used. And one of the unique feature of Zenit 5222 is that it crosses blood-brain barrier, and therefore a patient got cured in 4 weeks treatment, and he went home. And this is absolutely a life-saving situation. And this was the first case of meningitis being treated with 5222.
So, Samina, Tamanna is also in the studio with me, but I am...
Okay, fine.
That's fine.
Hi, Mr. Kurakiwala.
That's okay. Just to talk a little bit more about this, because the last time we talked, this was not tested on a meningitis patient. And I know the WHO very recently has indicated that one of the biggest challenges they face is people dying because of drug resistant, and the number stood at 5 million annually. When you started working on WCK 5222 in the early part of 2022, in your anticipation, was the size of the market as large as it is today?
Yeah, we knew that drug resistance market is very large. Nearly 5 million people worldwide dies every year. And in India, the incidence is about 1.1 million incidents. And we knew the market, but what is unique happened about Zenit is this compassionate usage, given a scope of most difficult cases getting treated. The other thing is the center which gives a break point, and the higher the break point, the better it is. It has a 64 break point. And in the last 100 years, after penicillin discovery, no antibiotic, there are 250 of them more approved, have received such a high break point. And as a result, the higher the break point, the drug is more effective. And that is what is being proved in clinical practice.
Mr. Kurakiwala, Tamanna here. That just sounds like we are sitting on the verge of a new chapter in treating antibiotic resistance. So what is the break point here versus what is currently available in the market, just to understand and take forward from what you said last?
See, Tamanna, all the recent antibiotics which are cleared by regulators have received a break point of 2 to 8. And we are talking of a break point of 64 for about 10 different organisms. And this is historical. And it is actually a breakthrough in treating multi-drug resistance, because all these 10 organisms, which is really responsible for multi-drug resistance, our drug is going to be effective for a fairly long period of time.
And this is beyond just meningitis, sir. Can you just give us a sense of what would be the real application for this, and at what stage do we see this all come to fruition in terms of availability in the market, etc.?
In addition to meningitis, you have lung-related infection of HEP and VAP, where it is patient is on ventilator. So, and there are bone infection which are very, very difficult to treat. And therefore, I think literally Pseudomonas, Acinetobacter, these are the organisms which is very, very difficult to treat. There are hardly any drugs. And that is what 5222 or Zenit is doing. As far as progress of our clinical trial, our phase 3 global phase 3 clinical trial would get over in next 2 to 3 months. And we should be filing for US, Europe, regulator India sometime in the second calendar quarter of next year, and hopefully get an approval in early 26.
From what we understand, actually, let's talk about approvals in a minute. You want to quantify the size of the opportunity that you know as of today. I know this is something that will keep developing as you go along and keep testing it. But as it stands, what is the market size of this opportunity, and what could be your market share once you bring the drug to the market, say in FY 26-27?
That is very, very difficult to say. But just to get you an idea, the US has an incidence of multi-drug resistance of about 700,000 patients, 500 to 700,000 patients. And we believe that the older drugs, which are approved recently, may constitute about 20-25% of that market. The balance market is an opportunity available to us. And normally these drugs are being priced today in the US at about $8,000 to $10,000 per treatment.
Right. When do you look to launch this? Will it be a one global launch of the drug, or will you be taking one market at a time? Of course, you can't price the drug in India at the same price as it is in the US. Are you considering sort of breaking the market by bringing in lower prices? Would you compete on pricing, or just simply on the fact that what you're bringing in has better success rate?
See, generally we will discount for Indian market by at least 75 to 80% of our US prices. So, because one of our objective is not to have the product success in US and worldwide, but also make it affordable. So that a large number of patients can use it, and therefore they can save lives. So we have a dual purpose here, that we make these drugs available worldwide, and as per the ability to pay, the pricing will be adjusted accordingly.
Sir, just trying to understand what is the possible headwind. Right now, it looks like a very exciting journey. You've talked about FY26. What is the possible challenge or downside that you have factored in and that our viewers should know about?
I think as far as my drug is concerned, 5222, 35 cases of compassionate use, where they were all extreme cases, all existing antibiotic in each of the case were used. And that is how a drug goes in the compassionate use category. And we had 100% success. So in terms of efficacy, it is no issue whatsoever. But what is equally important, because some of the cases like bloodstream infection and bone infection, they were very serious. And nearly a patient was on a deathbed. And we were able to give safely the drug up to 70 days in some cases. So the treatment was 7 to 10 days to 1 month to as long as 70 days. And it was safe. And there were no side effects observed. So both efficacy and safety, it's a kind of a very unique drug, and it can be used freely in all kind of cases where no other antibiotic works.
Are you looking at licensing deals with other companies for this, Mr. Khurakiwala, going forward?
Yeah, we are looking at that option for Western market of a licensing. And we will initiate that process sometime early next year.
So just doing a little bit of a digression from WCK 5222 to WCK 4873. Where does that stand in terms of a launch? What is the timeline? Are the approvals already in?
Dicnab, that is 4873, is a drug for pneumonia, and it is a tablet. It is ultra short treatment for 3 days. We have completed phase 3 clinical trial and submitted to drug controller for approval in April of this year. And we hope to receive the approval in next month or two. And thereafter, we will launch the product. It is also a very unique product in the sense the existing drug like azithromycin has about 60% resistance cases, so practically it has no value. And augmentin, which does not work on atypical pneumonia, which is about 30 to 40% of cases. And since it is an oral drug, there is no pre-investigation required normally. And chest specialists and others, and it works in 3 days. And about 1/3 of patients of pneumonia go to hospital because there are no adequate oral treatment available. Some of the patients are very serious and they will have to go to pneumonia, to the hospital. But I think a large number of patients can be treated with the drug, oral treatment. And I think that is what McNair for 4873 in pneumonia will work.
Sir, so hopefully the approval should be with you next month, like you indicated. Post that, you'd look at doing a launch, which could be maybe 2 to 3 months out. Would it be a fair assumption that in the third or fourth quarter of the current financial year, 4873 will reflect on your earnings, your revenues, and your profitability?
I could say that in the fourth quarter, it is more likely that our product would be in the market. But a new drug, irrespective of how good it is, it has a very limited financial impact in the first few months. But certainly it will have some impact on FY26.
And one quick question regarding your 15-year multi-vaccine collaboration with Serum Institute of India. I know we talked about this and you shared with us where things stand last quarter, but any update on that? Are you bringing in any products on that front? Can we see this turning revenue accretive, if not today, but over the course of the medium term?
I have no update on what we mentioned 3 months back, and the situation is same. Actually, Serum is working on two of the vaccines, and they are at various stages of late stages of clinical trial. So we would see some kind of progress coming in FY26.
Right. Dr. Korakliyawala, one last question. You've obviously spent significant amount of time and money on developing both WCK 5222 and WCK 4873, and both are coming to culmination as we see it. Any more investments you anticipate lined up to be made in any of these two products? I know your recent QIP funds for that of course that you raised were also directed towards 5222. But any more big investments lined up?
I think we have to complete the phase clinical trial, and there would be some investment required because we have other portfolio of product. So our NC investment will continue to be there, but not as significant as it was there in last 2 years.
Thank you so much for speaking with us, Dr. Habil Korakliyawala there. Wockhardt in focus, and truly, I mean, beyond just what we're talking about today in terms of the stock price and the company and for investors, if you have this kind of a breakthrough for multi-resistant diseases, it's really going to change things in a big way. But let's cut across now to a conversation with Sajid Chinoy, India Chief Economist at JP Morgan. My colleague Niraj is speaking with him.
Dependent on what the Fed does or not really?
So let me answer this in two ways. I think one is Asia more generally. I think Asia is one region in which most economies in Asia are below their pre-pandemic path. And that's just another way of saying there's a fair amount of slack in many Asian economies, which is why core inflation in Asia has been so soft. It's the one region of the world, unlike LATAM, unlike EMEA, that you actually had very soft core inflation. And if you look at real rates in Asia, so policy rates in Asia deflated by core, these are very elevated. In other words, many of these countries should have been easing a year ago, but they could not ease because many of them are small open economies, and what happens in the Fed affects them directly, and their policy rate differentials with the US are at historic lows. So if they had cut interest rates unilaterally or preemptively, there would have been more pressure on their currencies and more financial stability considerations. Now, with the Fed cutting, it opens a green light to these economies. We saw Philippines cut in August. We saw Indonesia cut last week. So you'll get a slew of rate cuts in Asia, I think, Philippines, Indonesia, Korea, Thailand in the fourth quarter. India is in a slightly different camp because India has this war chest of reserves. So the Fed's actions didn't really affect India as much as it did many other economies in the world. And the simplest way to appreciate that is to understand that India's interest rate differential with the US used to be 5 percentage points. It's come down to 1.5 percentage points. So the Fed kept hiking and India did not have to hike because we've got this huge war chest of reserve. So while the Fed's actions make it easier for the RBI to move, I think primarily this is going to be domestic growth inflation dynamics that drive the RBI.
So what's your sense on that then?
My sense is that with every passing week, the news on inflation is getting better. Remember, core inflation, like in many parts of Asia, has been very soft in India for the last 9 months. The issue was always food inflation. That's 46% of the basket, averaged 8% for the last year. So the RBI correctly wanted to ensure that food inflation gaps down sustainably, because it's food that drives inflation expectations. Now, the good news is very strong monsoon, good sowing, global food prices are benign. There's more evidence that food is gapping down. We're seeing inflation undershoot the RBI's own forecast. So I think we're getting closer to an easing cycle. Now, whether it's October, whether it's December, will come down to the RBI's need to assess whether they need to see more data, right? Because as the governor rightly says, this is not about any 1 month being 4%. This is about having conviction that the next 9 months are in the low 4s. And I think maybe the RBI will require a little bit more time to be certain of that, right? So, but the one point that I think not just the RBI but many central banks in the region have to worry about is, in this world where you have a potential soft landing, right? Risk assets are going to be on fire, right? And you want to be careful as a central bank not to stoke more financial exuberance. So the Bank of Korea is in the same dilemma, that you may have to ease interest rates because inflation is settling towards target. But at the same time, you want to be very vigilant that there's not excessive financial exuberance, and therefore macroprudential measures may well need to be used in tandem to tame those pressures. And I think that's the balancing act that many EM central banks will have to contend with in a world in which the Fed is cutting because the US is heading towards some kind of soft landing. Again, that's not an assured outcome, but that's at this point what many people's baseline is.
Most probably. Yours too, I presume. Most probably.
JP Morgan's baseline, yes.
Okay. From an India perspective, though, some people attribute the lack of pickup in private capex also to the fact that interest rates are stubbornly high. The RBI has an unenviable job then. If it doesn't cut rates, presuming that that's the reason or one of the reasons, then the private capex cycle, which has been waiting, and the government capex might be peaking as well, you would have an insight there too. What happens to the private capex cycle therefore?
So I'm not convinced that the private capex cycle has not picked up because interest rates are high, because if that was the case, you would have seen booming private capex 2 years ago when interest rates were very, very benign in the pandemic, right?
No, I mean a combination of...
and I think it's a good point. I think the distinction is, even though interest rates may be where they are, if you look at financial conditions more generally in India, same issue with the US, they're very benign. Look at asset prices, look at where equity markets are, look at where credit spreads are, look at where liquidity is. Financial conditions actually are very benign. My sense, I think, on the private capex cycle is something that most emerging markets are contending with, which is the elephant in the room here is massive Chinese excess capacity. Right. Now, when you've got so much excess capacity that's flooding into different markets as far apart as Brazil and India, corporates are going to be a little bit more wary of saying we should only invest when we have clear demand visibility given this excess Chinese capacity. So I think we're right in the sense that we need, and I think this process has begun but needs to culminate, is there needs to be more demand visibility for Indian corporates, and when they see that, then there's more of an incentive to invest given that you're competing with a lot of Chinese excess capacity. There's one statistic I'll just throw out on China. China is on course to producing 70 million electric vehicles in 2030 by itself. 70 million. Global demand for EVs in 2030 is expected to be 44 million. China is on course to producing 150% of what the world is going to demand in terms of EVs. That's the quantum of the China shock 2.0 that the world is up against, right? So we need to be realistic in that environment.
Wow. Sajid, I have a question on the rupee too, but before that, I'm just throwing this out at you. China is producing mammoth sums of all commodities and goods.
Right.
It is not consuming as much.
Exactly.
World is not necessarily a growth place currently. Europe, rest of Asia, etc. Maybe Japan leave out. What happens to asset prices in such a scenario, or goods prices in such a scenario? Do we see a massive deflationary factor?
Absolutely.
And therefore, is the private capex cycle going to be a lot back-ended than what people believe?
I think it's clearly a pressure point. You're exactly right that we haven't seen the Chinese rebalancing that people had hoped for. There's a huge focus on production. Chinese domestic demand remains very soft. So far, China has been benefiting from strong external demand. But if the global economy is gradually slowing, you can't even be sure of that external demand, right? So where is this capacity going to go? And this is where you get things like trade wars starting, right? The US may well, if there's a Trump presidency, may well impose higher tariffs. Then that capacity may well come to Asia, right? So every country is going to be kind of vulnerable to this excess capacity, and that will clearly have a bearing on investment cycles all around the world.
So India too, there is a likelihood that the private capex cycle might be back-ended for the right reasons, of course.
Yeah.
Because the corporate, as you said, would be very...
I think it comes down to demand visibility, right? I think what Indian corporates will need to see is, if you do see more visibility on consumption, if we do get a couple of more years of public investment by the government, if you do see some strands of export growth picking up, then there's an incentive to do so. But we do need to see that demand visibility for corporates to invest, in a significant manner.
But what's your sense on demand and visibility thereof the next 15 months?
So I think the good news is that we're finally, after a long time, seeing rural consumption pick up. But we need to just ensure that that sustains and that continues. We also have to be mindful that urban consumption, which has been driving it, doesn't slow in tandem. So what you want to be sure of is this is a consumption acceleration and not a consumption rotation. That urban was driving it, rural was soft, now rural is picking up and urban is slowing. So we'll have to wait and see how that plays out. I think the other important point is public investment. And again, the government capex, central government capex has doubled in the last 5 years. And it's important that that goes on for another couple of years at least, while the private sector steps in. And the way to square that is, if we want public investment to not come off sharply, but deficits have to come down for debt reasons, then the focus has to be tax to GDP. So I think India, in the next couple of years, will have to continue down a path where we mobilize revenues, and this becomes a revenue-based consolidation so that we protect public investment. Again, there the initial signs are very encouraging. Last year, gross tax to GDP was 18% for the first time ever, the highest ever. So we have seen some progress on that front. We need to see more progress on that front so we can bring deficits down, but still keep public investment high to provide that visibility to the private sector.
Got it. Wow. Interesting point. My final point, and I mean, I'm just out of the blue just asking you about the rupee. I'm just trying to think. It's a global easing cycle, if you will, save for, or maybe an idiosyncratic easing cycle, but largely easing.
Yes.
What happens to the rupee, you think?
I think not very much. And I'm saying that because I think the policy actually is the right one. So the way to think of the rupee is to look at the broad trade-weighted real effective exchange rate. That is the broadest measure of competitiveness. And I keep saying that we want exports to grow. We don't want to be flooded by Chinese imports. The last thing in the world you want is a stronger currency. Because if you have a stronger currency, A, your exports become less competitive, and B, your imports, especially from China, become cheaper. Right? So a strong currency is not in the interest of India's growth. And I think the RBI has correctly been ensuring that the broad trade-weighted exchange rate has been flat or very stable in the last 5-6 years. People keep asking, well, why are they accumulating so many reserves? Because if you're focusing on, you can either control price or quantity. You can't do both. The RBI has correctly focused on price, which is the real effective exchange rate, which means quantity becomes endogenous. I have to buy or sell as many dollars as I do to ensure that. So I think that's the right focus, A. B, the reason that India could deviate from the Fed and that interest rate differential has come down is precisely because we had this war chest of reserves. The fact that we have $700 billion, the fact that the current account is very benign, the BOP is in surplus, gives the RBI those degrees of freedom to not have to follow the Fed and to bring those differentials down. So I think we must appreciate, what those reserves have bought for us. And the final thing I'll say is, unlike many countries in Asia, our reserves are not earned reserves. In those cases, they were current account surpluses, countries, and they earn that reserves. Our reserves are borrowed reserves in the sense that they are built through capital inflows. So for every dollar the RBI is holding, there's a dollar in the economy, a liability in the economy which can unwind. So I think the RBI's policy has been very appropriate on the external front. And I think we should continue on that in that vein.
And if the rupee kind of stays stable, if you will.
Stays stable. If we get a chance for it to weaken, we should welcome that because, again, that improves India's external competitiveness.
Great. Sajid Chinoy, always a nugget or two that comes out at the very least. Today was no different. Thank you for your time. and have a great conference.
Always a pleasure. Thanks very much.
Well, the pleasure was ours, and viewers, thanks for tuning in.
Welcome, you're watching Talking Point. I'm Tamanna Inamdar. Well, a lot of conversations lined up for you over the next half hour, but before we get to any of them, let's just give you a sense of what's happening in the markets right now. The Nifty above the 25,900 mark fairly comfortably. Will we hang on there is what we need to see. We've had a decent start to the morning. The Nifty about 0.5% up. A bit of an upswing in the last few minutes of trade as well. Autos seem to be dominating the entire trade today. But let's go across now to Mr. Anil Gupta. He's CMD of KEI Industries, and he's joining us because of an announcement that has been made. They have commenced production from their Pathredi plant 2 in Alwar for LV and MV cables. That is low voltage cables and medium voltage cables. This is an expansion in this space for the company. Mr. Gupta, thank you so much for speaking with us here at NDTV Profit. Can you give us more details about this plant and this brownfield expansion that you've seen?
Actually, this expansion, good morning.
Good morning.
This brownfield expansion was started in April last year and completed in August, and we commenced commercial production last week. Has a potential to generate a yearly revenue of around 750 to 800 crore rupees. It is a brownfield expansion adjacent to our existing factory in Pathredi and going to manufacture LT and MV cables for power sector as well as oil and gas and other construction sectors. This year, the potential is to, have a revenue of around 250 crore rupees in the next 6 months. But on a full year basis next year, it will generate a revenue of around 750 crore rupees.
So, what is the further kind of capex you're seeing for the rest of the year, Mr. Gupta?
Our major capex is now coming up at Sanand near Ahmedabad, which is a greenfield expansion at a cost of around 17 to 1800 crore rupees. And the first phase of it is likely to be commissioned by May or June next year. And the overall full project will be commissioned by March 26.
Okay.
As of now.
Okay,
Yeah.
so the major one next is in Sanand, Gujarat. Pathredi is pretty much done. This is in that Bhiwadi area. What is the kind of output you're expecting from Pathredi, and do you expect it to scale up from here on? Give us a sense for what the targets are for this financial year.
I have already mentioned that it has a potential to generate a revenue of 750 to 800 crore on a full year basis, and in the first 6 months, we expect to generate a revenue of around 250 to 300 crore from this facility. But next year, the full capacity will be utilized on the whole year basis.
What would that be?
Yeah.
What would the full capacity utilization look like?
Around 750 to 800 crore rupees on an annual basis.
Okay, got it. Let's just talk a bit about your margins, Mr. Gupta. You've maintained margins between 10 to 11% in the last few fiscal, but now that you have more capex on board or you have more facilities on board, do you expect those margins to go up and economies of scales to kick in?
No, this year we, since the growth will be limited due to the capacities, so this year we expect the margins to remain range bound within 11%. But as the new capacities come up next year, we will try to improve upon it. Revenue generation can grow by 15 to 17% in this financial year, or maybe more. It's a initial guidance.
Okay, so 15 to 16% continue. Let's just get your sense on exports. Exports were down last quarter, logistics issues, etc. Are you seeing that recovery already in quarter 2?
Yeah, it will be. The recovery is there and it will be made up. We are expected to grow by 30 to 40% in exports in this whole financial year. I'm not talking of quarter-wise, but we have substantial orders in exports from our various overseas customers.
Okay, just last question really is the kind of gains you're seeing in the branded housing, wire and cables space, Mr. Gupta. What is your current share and how far do you see yourself going?
See, we are growing in branded houseware sector by around 25% on an average. So at the moment, our market share is around 6%, and we expect to take it to around 9 to 10% over next 3 years. That is our plan.
All right. Thank you so much. Anil Gupta, the CMD of KEI Industries, a buzzing stock, and of course, some news flow coming in there as well. All right, let's get to our big conversation this morning on Talking Point. And, our next guest is speaking to us at an interesting time for the markets. I would say that in the last week or so, there has been a mood change. Very little doubt about it, because you've had that 50 basis point come in from the Federal Reserve. It was something that was anticipated and being waited for in all global markets and in India as well, in the context of what are the kind of foreign flows that will be coming in. Now, Friday's trade seems to suggest that most concerns, will we have a soft landing in the US? Are we looking at any kind of recession? Seem to be behind us. From an India perspective, foreign flows look poised to re-enter. So what really should be the outlook? Are we now set for 26,000? Quite firmly on the Nifty, and what next? Joining me to talk on this is Mahesh Patil, CIO of Aditya Birla Sun Life AMC. Mr. Patil, a very good morning to you, and a great time to have this conversation on what seems to be like a good day. Let me just come to you, and I know you would probably say that it's just a number, but the distance to 26,000 seems like an exciting one, isn't it? I think you're on mute, Mahesh.
Yeah, sorry about that.
There we go. Yeah.
I think markets again this year looks to be a good year. I think clocking in year till date, right? And it's been rising again to some extent, driven by domestically. I think the growth momentum continues to be fairly decent and strong. GDP numbers have been strong. We've seen that the much awaited rate cut in the US is also now kind of started. And more importantly, I think the liquidity, right? The money flow into the market continues to be robust from domestic investors. So that is keeping the markets really up. But also now, I think post the rate cut, and I think with dollar likely to weaken from here, we could also see emerging market flows of flows into India, okay, which have been kind of tepid, okay, for the last year or so, could also tend to reverse a bit. So I think the direction of the market looks to be fairly on the uptrend, though I would say that clearly the market, while it would continue to probably move up, okay, but we would probably see some more volatility coming in down the line because you have elections in the US. Okay, the outcomes there could lead to some volatility on the global front. So that is something which I think one needs to keep in mind. But I think one interesting thing what we're seeing is that while the Nifty and the other headline indices are making new highs, the breadth of the market is now slowly starting to weaken. So what I mean by that is that if you look at the number of stocks which are down, say around 20%, 30% from their peaks, okay, in this year, I think the number of those percentage of stocks is now kind of increasing. So I think that's a slight change from what the market was doing, say, until, say, the beginning of this calendar year. But otherwise, I think earnings momentum is definitely slowing down. So I think that should slow down the pace of acceleration in the market is what I would think.
Okay. No, just to come to some of the factors that you mentioned, Mahesh, and I think US elections, rightly so, is the next big thing globally to look out. At least the latest polls, and these things change, but at least the latest polls seem to point towards a Harris administration next. What does that mean for US markets and from an Indian perspective? I'm not talking about the politics of it at all, but from an Indian perspective, does that make a big difference to us and to the US markets?
Yeah, I think so. In a way, from a US market standpoint, I think it would be probably continuation of the existing rule of the Democrats, right? So the policy of the earlier regime would continue. So I don't think that should lead to any large volatility over there. Obviously, the stimulus would be in terms of how do you prime the US economy and ensure that there is a soft landing. And I think some of the measures, okay, which the Democrats and Kamala Harris has talked about in terms of generating employment, I think that should be positive. I would say that in that context, I think the volatility in the US market could be much lower, okay, if that is the outcome what we are looking at. And even from an India perspective also, I think I would say that it should be fairly normal. I don't see any reason because Trump would have mean that there would be more tariff barriers. Okay, at least the rhetoric there could have been slightly negative for India.
Okay. In terms of India right now, do you think, Mahesh, that we will see those global flows coming in? I mean, the numbers for Friday were astonishing. Some say it's because of the FTSE rejig, and a lot of them are passive flows. I don't know what your take is on that, but do you see that sort of floodgate opening now?
It's not like, I mean, we're not going to see the floodgates opening and big money coming in. But if you look at 2-3 data points, it suggests that probably you should see the reversal, okay, of the outflow, what we have seen in the better part of this calendar year. So, one is the rate cuts means that you will see that US dollar starting to weaken, and that's been now quite apparent. Okay, that would mean that more money into emerging markets, and India should get its share over there. Also, point to note is that India's weightage in the now emerging market index, or even the global index, is at an all-time high. It's now overtaken China also, right, which is to be close to around 22%. And relatively, if you look at the global funds, I mean, all the emerging market funds, fund managers globally are now slightly underweight India. I mean, historically, they have been overweight India, and the overweight has been as high as around 3 to 4%. Right? That has now gone to marginal underweight. So I don't think there is room for FIs or the foreign investors to really go underweight in India beyond this point, because India is a relatively better performing market, right? So in that scenario now, I think I would say that you should see the flow starting to improve. Obviously, India is relatively expensive vis-a-vis the region, and that could always be a debate, and that is what has kept foreigners away. But I think there won't be much choice because India remains a good long-term growth market and foreigners would want to participate in that. So I would say that you should see at least the FII flows starting to turn positive, though I would not likely to say that you would see a large number coming in, because unless there is a correction and some moderation valuations where you could then see more money coming in big quantum from the foreigners.
And will that be coming into banks? I'm wondering how right now, Mahesh, you're feeling about banks, private banks. I know you'll not tell me about HDFC specifically, fair enough. But, I'm wondering if you're feeling some of that concern, which we were seeing at the end of the last quarter numbers on deposit growth, etc., ebbing?
So on the banks, I mean, one is on the technical side, if you look at it, that there have been huge sell down by FIs in the banks. So when they were selling, the bulk of the hit was taken by the banking sector because that's where the larger ownership was, especially some of the larger banks, okay, where FIs held a larger chunk. And that's why now I think after the last selling, I think clearly the positioning in the banks from the foreigners seems to be much lighter. And banks continue to be a large liquid name, right? So whenever money flow starts to revert, I think that's the sector which could probably attract some of that flows. Also, banks, if you look at the private banks in general, they have underperformed, right, in the last 1 year or so. And the valuations there are more reasonable if you compare that with the long-term averages, right? So clearly there the risk reward looks more favorable and you could see more money chasing that, and that could possibly be a rotation back into the banks and you could see a relative outperformance over there going forward. So I think that could be a reason why I think you could see banks potentially doing well. However, the headwinds from the banks in terms of the deposit growth, I think that still remains, right? Okay, that is still a challenge, and that's the reason why there have been downgrades to the credit growth for the banking sector in this fiscal year to now around 12-13% compared to around 14-15% earlier. But so I think that, but I think the overall system liquidity, if you look at RBI liquidity, is now starting to improve. So that should give some relief in terms of garnering deposits. But clearly that remains the biggest challenge at this point in time for the banking system.
Just last point from you, Mahesh. You know, we spoke a bit about banks, but in terms of the sector rotation that we've been seeing in the markets right now, what is looking most exciting to you? What are you most constructive on? And will rate sensitives like autos and realty make that list?
So, yeah, I think in a way, I would say that there are a couple of things which we are positive on. One is consumer discretionary side, because that is more likely to be influenced by any rate cuts. Okay, we see a lot of now consumer discretion buying happens based on leverage, okay, or loans, and that any increase in cut in interest rates in India, probably 6 months down the line, could mean that you would see more disposable income at the hands of the consumer. And this is a sector which had underperformed last year. It's only starting to pick up now in the last 3 to 6 months. So structurally, we think that's a sector which can do well from here. Also, the rural economy is, again, there are some green shoots there about it picking up. Rural wages are slowly, the real wages are starting to improve. And the monsoons have been fairly okay, so you should see that picking up. So I think second half, I think rural demand could pick up, and that could also drive demand for some of the rural plays. So these are some of the themes which one can look at from a medium-term perspective.
Okay, thank you so much, Mahesh Patil there, talking about what the themes are, and definitely consumption is one of them. I mean, we talked earlier today about a CLSA note which managed to quantify all the angst and excitement about Coldplay tickets into a stock idea, which in their view was Zomato. So, that theme definitely will continue. But as part of our special coverage of the JP Morgan Annual India Summit, my colleague Niraj Shah caught up with the head of equity research for JP Morgan, Sanjay Mukim. Listen in to a bit of that conversation.
Well, we are live at the JPM India Investor Summit and in conversation with one of my favorite spokespersons, Sanjay Mukim. He's head of equity research at JPM, joins us. Sanjay, it's been a really long time, but glad to be here.
It's a pleasure being on, Niraj. Thank you for having me.
No, the pleasure is entirely ours. So, Sanjay, big conference, and I'll come to the detailing of the conference as well, but I'm judging by what you told me just before the conference that the India interest is very, very high. This is arguably, if I'm not wrong, as somebody was telling me, one of the largest investor conferences that you've done at JP Morgan.
That's right, Niraj. It is a reflection of the interest in the Indian equity market. Our attendance ratios have hit 1,000 delegates for the first time for a physical conference at JP Morgan. We are up in headcount about 30% YOY. The number of corporates who are attending, the number of clients who are flying in from overseas destinations to join our events, the kind of speakers we have at our main tracks. This is all a reflection and I think a vote of confidence in the markets and the economy.
Okay, and it's happening just at the right time, right? Because we've seen the first of the rate cuts from the Fed. Everybody's talking about we being in an easy cycle, though it's idiosyncratic because Brazil has raised,
yes,
Japan is raising, etc. But largely global central banks as a pack also cutting rates. How does that augur for risk assets at a time when valuations don't seem to be very favorable?
So it will roll back into the very, very hot debate, Niraj, of whether you're getting a soft landing or a hard landing. If you're cutting rates in a scenario where growth is okay, that's the best situation for risk assets, right? Equities conceptually are an asset class that benefit from low inflation and high growth. So if you get inflation coming off, which is why you get a rate cut, but growth is sustained at a reasonable level, asset prices will be supported everywhere. However, if the rate cut is happening because growth is slowing down significantly, then that's a very bad situation for equities or growth asset classes, right? I think the debate is still out, which sort of a rate cut we've got. As of now, the market is of the belief that it's the former, that growth is fine, inflation's come off, it's great for us. And therefore, what we need to watch everywhere around the world, not just in the US to my mind, does growth hold up or not? Because if it doesn't, then equities might come under some pressure.
What's your prognosis about the India growth, therefore? And what are you telling clients out here? 1,000 odd people, you said, right? What are you telling them?
Well, mechanically, our printed growth numbers will come off, right? And this is just the math of the base effects and the way the deflator is calculated. We've seen that in the June quarter, and that trajectory of it coming off a little bit mathematically is going to play out over the next 3 quarters. The only thing that's worth noticing is that India has had GDP upgrades in the previous 3 quarters, where printed GDP numbers beat everybody's estimates. This quarter, we've actually got a minor GDP downgrade, where it's come in lower than, let's say, the RBI's expectation. And this is reflected, if I may segue, Niraj, in earnings in the market as well. Whereas for the previous 3 quarters, earnings were beating estimates and we were seeing upgrades to, let's say, the Nifty or MSCI India EPS. This quarter, around results season, we've seen downgrades. 2 out of 3 companies have missed numbers, which is very rare for the first quarter. And we see a minor downgrade to the index EPS number as well. So on momentum of activity, whether it is through GDP or through corporate earnings, we've seen a minor deterioration in the market in the last quarter.
Okay, but if FY26 numbers, estimates out there look okay, let's work with that assumption. Are markets egregiously valued for you to tell your clients here that, hey, be very, very choosy about India despite the interest? Or do you reckon people will go out and say that India is amongst the few bastions of growth? I mean, Japan, Spain, India, maybe US, very few economies growing and very few economies showing earnings growth. So never mind the valuations, let's put in the money.
So again, you can make multiple stories out of this, right? If you look at the Nifty 50, the top 50 large cap stocks in India, the weighted average PE is exactly the same as the S&P 500. Right, so there is no premium, there is no discount, and we've traded in line with the S&P for many years. So in the context of a global equity valuation, India is not overpriced on the large cap basket at all. Yes, individual sectors may look well above average, and you can pick and choose those kind of data points. But the index itself, relative to equities in the US, is fairly priced in a way. However, if you go down the rung, Niraj, and you start looking at stocks in the 101 to 500 or 500 to 1000, and you take various cuts of that, all of those are at all-time high PEs. Right? And PEs are difficult to contextualize because of the narrative of growth. If you then backwork on a DCF, or if you look at the implied equity risk premiums, etc., on a very mathematical analysis of valuations, the equity risk premium in Indian equity markets is at all-time lows, meaning that the amount you're getting paid for taking the equity volatility is the lowest that it has been in decades. And this means that equity as an asset class is reasonably overpriced.
Okay, so therefore my question, are you telling people to be very, very picky, or are you telling people that, still India will be good enough for your dollars to come in and get parked here? What's the message at the conference?
Right. So look, we cannot tell people to stay away, because if they have a mandate to invest in India, if they have raised funds to invest in India, they have to invest in India. So telling people to not buy India is not really helping my investors. However, there are 2 or 3 points to make. If you buy at elevated multiples, the future return expectations have to be moderated. And let me give you a data point. If you had bought at the top of 2008, which was the top of the previous bull market bubble, even today, which is all-time high valuations, etc., your CAGR is only 8%, right? So timing of the market does depend or does drive future returns. So if you're buying at elevated multiples now, please keep your return expectations moderate. Yes, Indian earnings will grow better than other people's earnings and all of that, but don't expect a 15-20% CAGR in Indian equities for the next 5 to 6 years. You have to moderate your expectations of returns. The second point that we make, and this is slightly different from what you were probably talking about, is liquidity, right? And what always happens in every bubble, everywhere in the world, the first thing people forget is liquidity. And what this means in the equity context is, let's say you bought a stock today which is trading $30 or $50 million today. In a down cycle, your ability to sell the stock as a large cap institutional investor gets diminished significantly because the liquidity disappears. So the second filter that we advise people apply in their India investments is a quality portfolio filter, where stocks will continue to trade even in a down cycle. You will have the opportunity to buy and sell even if things go sour, right? And things can go sour for a variety of reasons, global equity risk off or whatever. Do not get tempted by the hot tip that you got of a stock that's doing extremely well. Make sure you keep your quality filters on in your India investment today.
Okay, fair call. So future returns moderated, but pockets within the Indian landscape might still give you better than the average return that the index will give you, right?
Yes.
So I'm trying to understand, where is it that those pockets are, and how are you choosing these? Are these on the basis of earnings growth, or, as you keep on telling me a number of times, earnings beat is more important?
Correct. So let me talk about the second part. We've done a lot of quantitative work, correlation analysis. Stocks on a 12-month basis are driven more by earnings beats or earnings upgrades than to mere earnings growth, right? In fact, the correlation of earnings growth to 12-month returns is 0. Right?
Interesting.
Yes, it's because the earnings growth is probably already well understood and is priced into the market. Of late, however, we're seeing some of that correlation deteriorate because it's becoming mid-cycle, late cycle, whatever you call it. So the correlation with earnings beats is weakening a little bit, but it still has to be one of the key filters in processing stocks in India. Without being too bearish, if you ask me about the prospects of Indian growth and economic growth, we can be reasonably positive. There is a lot of upgrade happening in India. There is a lot of assurance of growth. Whether it is 8% or 6% is a debate, but it is still going to be a world-beating growth rate in many pockets. You're seeing, like I say, India benefiting from the increase in per capita incomes. So the few sectors that we think will continue to benefit, we like, let's say, the real estate space in the country. India is massively underpenetrated on residential real estate. Plus, there's a second driver, which in India is, what do you do with your money? See, one of the big reasons money is coming into equities is because fixed income is not investable, especially if you pay full tax. And therefore, whatever savings are generated necessarily goes into either equities or real estate. So equities markets is doing well. We think the real estate market will continue to do well. We like that sector significantly. We like, let's say, power. Where the power sector is reasonably tight. This is consensus. Everybody understands that demand supply is tightening fairly quickly. Which stock, etc., is a debate to have, but the sector itself looks good. Banks are slowing, Niraj, and they have significant challenges because of a lack of deposits. But that's where the valuation comes in, because it's the only sector where valuations make some sense. So if you have patient capital, if you're looking for nice quality, large cap companies, where you can live through a bit of a weak growth phase near term, I think banks look great. They've looked great to us for 3 years, to be honest.